Interesting take there, Mr. Chennai. Thank you so much for taking out the time and speaking with us at NDTV Profit. All right, now Apollo Hospital is in focus. The healthcare company has decided to spin off 3 of its businesses into separate companies. Varsha is joining us with more details on that. Varsha?
Yeah, thank you so much for that. So yeah, the new company will be listed on stock market and the transaction will be completed in next 18 to 21 months. Now, the overall point here is what's in for Apollo Hospitals, why the stock is buzzing. One is the valuation gap is expected to narrow down because the loss entities are hyped off, and the Apollo Hospital business, if you see, is trading at a 25 to 30% discount to some of its peers like Max, and so now there's a potential of hospital business EBITDA margin to expand, because if you see on an overall standalone basis, the hospital margins are at 24%, but on a consolidated basis the margins are at 14%. So now there's a chance that because of this loss, the loss business will be hyped off, you'll have a good EBITDA margin on the overall basis. Lastly, if I want to talk about the con call details, they're going to list this new company in 18 to 21 months, and the healthcare services will remain in AHLL. The new company will have revenue of around 25,000 crores by FY27 with 7% of EBITDA margin. They're looking to grow 22 to 24% year on year when it comes to AHLL, and came in on the back of the growth in pharmacy business. And the insurance business is also expected to contribute to the growth. They're going to achieve break-even in EBITDA in Apollo Digital by end of FY26. On the overall hospital level, they're going to add 4,000 beds, and they're on track to add 4 hospitals in FY26. And lastly, their focus is on hospitals, plus they're committed to grow when it comes to their diagnostic business as well.
Okay, Varsha, thank you so much for explaining that in significant amount of details. Kush, your quick view on Apollo Hospitals. Where do charts stand?
Very good moves that we've seen over the last 2 months on this one. However, the 7550 level is a bit of a resistance level, a bit of a supply zone. This is the third time that the stock has been trying to close above that level, but at least so far there are indications that it may or perhaps may not. So I would wait and watch. The trend remains intact. If I had a position, I would for sure continue to hold with the kind of volume pileup that you are seeing over the last 4 weeks. Trailing stop loss in this case would be 73.50, but a close above 75.50 is what would take the stock much higher, perhaps even to 7700 and 7950 kind of levels. So all in all, bullish. Wait for the 75.50 mark to be taken out for momentum to begin.
Got that, Kush. But now it's that time of the show where we speak about some key news flows, as well as what my colleague Somit is hearing on the street. Is what we call in heard on the street. Somit, what are you picking up?
Well, firstly, the buzz is on Glenmark Pharma. Dealers are indicating that large HNIs have started to accumulate this counter in anticipation of some positive corporate development that could come in anytime soon. Second one is on Axis Bank. There are sell flows on FI at desk is what dealers are indicating. Hence, that's the reason the stock has been underperforming. If you look at the Nifty Bank Index, that's the top loser, down around 2.5% in trade, while other banks are not performing that bad in trade today. When it comes to Bajaj Finance, dealers are indicating that there are sell flows on HNI desk on anticipation of weak Q1 FY26 update that could come in. So keep an eye out for Bajaj Finance as well. And when it comes to Coforge, dealers are indicating that large family offices and PMS have been accumulating this counter, given the fact that Coforge, as per their expectation, could report not only a better number compared to peers, but also the growth number could be much better compared to what the street is estimating. So keep an eye out for Coforge as well. MCX, now that stock has been gaining in trade on rumors of a new product launch, new weekly product launch that the street is expecting, and hence that stock is up 1% in trade. And lastly, when it comes to Aegis Vopak, dealers are indicating that the anchor selling is largely over. The anchor lock-in had opened on June 30th, that is yesterday, and the selling is largely absorbed in, and hence there could be some bounce back in Aegis Vopak is what the dealers indicated.
All right, thank you so much, Somit, for giving us all those details. Kush, your quick view on Coforge?
Well, amongst the IT names, this is one stock. Am I audible now?
Yeah, I can hear you.
Yeah, among the IT names, this along with Persistent has been one of the names that has been shining and might well continue to do so. However, I'm seeing some negative RSI divergence setting up, which suggests that there could be some profit booking coming in So if you haven't bought it, I think you should wait up. A correction towards the 1880, 1875 mark, would make a good entry point. Perhaps the negative RSI divergence play also would have, acted out. So if you have a position, you could partially book some profits. If you don't, then wait for the 1875 mark, to come in and then go ahead and create long positions. On the whole, I prefer this along with, a persistent in the IT space.
Got that, Kush, but stay on. We'll be right back. A very short break on India market close. We'll be speaking with Sudeep Bandyopadhyay on a lot more perspective on this. Stay tuned.
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold ICICI CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers. Welcome back. You're watching India Market Close. I'm Harsh. With me is Neeraj, and we'll take you through the last hour or so of trade. Joining us as well this afternoon, we have Sudeep Bandyopadhyay, Group Chairman, IndiTrade Capital, as well as, of course, Kush still with us. Sudeep, how are you viewing markets at the moment? Very quickly.
Well, I think the bias is definitely positive. After the market goes up some certain amount, I think there is a bit of a profit booking coming. But by and large, the domestic trends are positive. Global news flow also is supportive at this stage. So we are witnessing positive market sentiments. We have to keep in mind the forthcoming volatility on account of the 9th July, approaching 9th July, which is when the Trump deadline runs out. We'll have to wait and watch, but we have to be prepared at some level for volatility.
Okay. Sudeep, in light of the fact that there has been a bit of a rally that has happened or already in the markets, Would you believe that the street might be in the mood to take some money off the table considering the July 9 deadline and whatever significance it may hold? We don't know as yet. You may well postpone it. Deals may well be struck before it. But would the smart money take some chips off the table?
I think so, Neeraj, because there is a lot of uncertainty, and there is no way to predict what's going to happen in or around 9th July. So smart money definitely will start booking some of the profit. The other reason, Neeraj, here is that Indian stocks are not cheap, so they are reasonably priced. In some cases, probably a bit stretched as well. So smart investors will definitely book some profits and wait in the sidelines again. If there is some kind of a volatility, some kind of a correction, they will come back then.
Sudeep, where is it that you are seeing smart money move out? Sector, stocks, pockets?
Well, we've seen a lot of profit booking happening in defense, and a lot of stuff. People have moved money out of defense. It's not that they don't like defense. They will probably again come back when the opportunity arises.
Okay, but that's just defense, Sudeep. Anything else?
Well, there can be multiple areas.
Sure.
I don't think railways is too far either. Some of the railway stocks do look again fully priced. So there also we can see power segment, though it's a great segment to be in for long term. Smart money may move out and again come back in.
Okay. Well, but Titagarh Rail interestingly showed some uptick there. I wonder if Texmaco, Jupiter Wagons, etc. in today's session at least are showing that sign or no. Titagarh up about a couple of percent point. Remember Texmaco had that big deal and that stock at 175 is okay. Jupiter Wagons is quiet. Okay. Won't trouble Kush with the chart check. Let's go on to a chart which is looking very, very strong today, and that's Gabriel India. Unveiled major restructuring plan to transform the diversified mobility solution provider. The stock has hit an upper circuit. Puneet Johnson with why so? Now, Puneet, one thing is that there is an announcement. Two is the implication of that announcement over the longer term. Take us to that.
Well, thanks so much for that. So we've actually seen one of the major restructurings in Gabriel's history over the last 3 decades, where company largely was a single product company operating in the suspension space. And they'd added a very recently sunroof as one of the key other verticals, but 90% of the revenue was coming from one single product. The interesting part is that Gabriel is part of the larger Anand Group, which also had joint ventures in their investment company. Now all of that, and that was the Asia company that we were speaking about, Asia Investment Private Limited, or AIPL. So this is a 3-way agreement between these 3 companies, Gabriel, which is the listed entity, Asia Investments, which is the promoter's investment company, and the third one is Ankemo India, which is also another entity which Gabriel will now acquire and have a 100% stake in. Now, the intention behind this is to consolidate all the auto businesses under the listed entity Gabriel India. They'll also have some business agreements to get this done aspect, but the larger operation is to make Gabriel into a multi-product company, and this will immediately get you the existing business revenues of all these verticals. So that's one of the positives coming in. Let's now look at the key aspect of this, that of course the scheme will integrate the business of Ankemo India as well, which is one of the key products apart from that, and then the 3 other verticals which include investments in 3 joint ventures, Dana Anand, Henkel Anand, as well as Anand CY. So these all will be now eventually integrated into Gabriel India as well. Now let's just look at quickly what these segments actually do. Now AIPL, of course, is an investment holding company. So let's quickly move on to the other aspect, which is Ankemo India. Now this one offers products like coolants, diesel exhaust fluid, which is not where Gabriel is present currently. So it's a new product vertical, and the other 3 verticals as we just spoke about as well. Finally, in terms of key steps for this particular merger as well, what could you watch out for? Because over the next 12 months, this is what the company is planning to do. The first one will be the merger of Ankemo with AIPL, and that will eventually lead to step 2, which will be the demerger of all these verticals from the promoter's listed entity into Gabriel India. Finally, we will also see Gabriel issue shares to the promoter's investment company AIPL as part of this aspect. Gabriel will share roughly 1,158 equity shares for every 1,000 AIPL shares to its shareholders. But what is the aspect of it is that currently the company has 4,000 crores in revenue. And all these new verticals consolidated, which come into Gabriel, also have a similar revenue number of 4,000 crores. Currently, they don't own 100% equity stake in all these verticals, so that will happen over the next few months versus integration with these joint venture partners. But this is one of the major restructuring that we've seen in Gabriel India over the last 3 decades, as I just mentioned. And we could see the re-rating just be starting off now. So the 20% move, while today, could be start of a much bigger move over the next few months.
Very, very interesting. Thank you so much for bringing us that, Puneet. Now, when you're looking at Gabriel India's market capitalization around 12,000 odd crore, top line, as Puneet pointed out, just a shade lower than 4,000 crores. Sudeep, you see this as a fundamental shift in the way Gabriel India should be looked at from a fundamental perspective?
To an extent, I think this is a very good development and welcome development from a point of view of Gabriel India shareholders and the future of the company. Definitely, it brings a lot of focus back and it consolidates the auto ancillary business under one roof as far as the Anand Group is concerned. So yes, it's a positive development. We'll have to wait and watch. These things take time to crystallize and materialize on ground. But I think it's definitely a positive development.
Okay. Sudeep, anything within the auto anch space outside of Gabriel that you're liking at this point? Because it's a space which has garnered some amount of interest over the last maybe couple of months. So, and it's been a space where returns have been outstanding over the last couple of months as well.
I do like Sona BMW. I think it's a good investment and good company to get into. Look, this entire tariff thing can again put a spanner in the works. One doesn't know how things will eventually settle because they have a lot of interdependencies and parts do move from one part of the world to the other. Even Sona has got that kind of dependencies, but assuming that the world gets back to a normal, operating mode, I think that's a great company to be in. And even from a long-term point of view, forget the short-term, these kind of fluctuations because of tariff and related issues. Sona BMW does look very good.
Interesting. Okay, so Sona BMW at that. And what within the auto space? We had the auto sales numbers as well. Maybe we'll touch upon that. But, there are a couple of stocks, Sudeep, which I've spoken about earlier this week, or maybe earlier last week as well. Force Motors, SML Isuzu, some of them really flying. Now, before I take a technical view from Kush, let me have your fundamental view on some of those.
Well, I think, we have been positive on Mahindra and Mahindra for almost more than a year, and we maintain our view. I think even if you look at the numbers which came out today, I think M&M definitely comes out as a winner. All the segments, they are doing pretty well. Look at the SUV, I think the fantastic set of numbers. Tractors, again, things are picking up, and the monsoon being what it is and the expectation of a very good monsoon, I think the tractor sales will further pick up. And I think it's a very good place at this stage. I think even at current levels, it's worth looking at M&M from a long-term perspective.
Okay. Kush, do you have a view within the auto pack? And I'm sorry we've come to you after quite a bit, so thanks for being patient.
Not an issue at all, Harshan. I was enjoying the conversation myself. So, no, I agree with Sudeep. M&M definitely, the top pick amongst, the passenger vehicles. But as far as the auto anchs go, Gabriel India is something that's already moved quite a bit. Now would be a time to perhaps start nibbling in terms of taking money off the table, start booking profits. Even I would go out and focus on the auto anch space some more. So 2 stocks here on slightly different theories. One is Lumax Auto. We've been discussing this stock about some time now. For about some time now, very good moves. Now negative RSI divergence is starting to creep up. You could see some profit booking. So, as in when you get a dip towards the 1100 mark, you should consider a re-entry or an entry into Lumax Auto. And the second one is Uno Minda. This too had a very sharp run over the last 10 sessions. Yesterday, today, it's seeing some profit booking, but now the 20-day support zone might act up. So if you see it holding around, these 1050, 1075 zones, then you could reconsider, an entry into Uno Minda as well. So I will have my focus on Lumax Auto Tech and Uno Minda and Gabriel. It's time to start booking some profits because the stock is locked in and over, in an upper circuit. You don't want to give it all up today, but as and when you get a chance, you should start exiting maybe about 20-25% every day if the circuit keeps going on for a couple more days.
Okay, okay, fair call. There's a set of listings that came in today as well, so keep that in mind. And we'll talk about them, some of them at least, the recent ones with Sudeep. But out of the four, Raymond is down, but the others, and Kalpataru was expected, but the other two, after starting off about 25-26% higher, are actually currently trading about 33% higher. So pretty good going there. Sudeep, any thoughts on the new listings? Any company that has recently come which has impressed you?
Ellen Berry definitely does look good, and even before the IPO subscription numbers came, we were positive on that. I think they're in the same space as Linde, and we know what kind of performance Linde has shown over the years, and the kind of potential this business has. So the EBIT margin is about 40% plus, and there is scope for further improvement. So I think this is a good business to be in, and I think the issue was also priced appropriately. So the guys who got allotment should be happy. And I think this positive trajectory in Ellen Berry will continue for some more time. Kalpataru also, I was reasonably positive, and I think we know what's happening in the real estate space overall and how real estate companies are performing. So Kalpataru is an established player in the MMR market, and I think there is potential for this company also to reward shareholders over a slightly longer period of time.
Okay, well, that's the view on the IPOs, and a clutch of them currently, IPOs, QIPs, has become a big thing, as have been government decisions. Now, we learned that the government is planning to make anti-lock braking systems mandatory for all two-wheelers. This was discussed, I think, some days back, and apparently the rule is set to impact two-wheeler companies, entry-level bikes, and maybe more. Puneet Johnson with what's the impact on major auto players? Puneet, why is it relevant today?
Well, thanks so much for that, Neeraj. So we've seen some positive impact coming in on endurance tech as well as something like an Ask Automotive, and that's largely led because these companies supply anti-lock braking systems or ABS products to these entry-level bike players as well. Now, this could have a larger business impact amongst these, and that's something which is putting the positive momentum on endurance tech specifically because they give ABS products from roughly 100 to 900 cc bikes. Now, over the weekend as well as yesterday, we saw that kind of confirmation come in from our sources at NDTV as well, confirming that the ABS rule will be coming in from January of 2026. And since then, we've started seeing that positive momentum on especially something like an endurance tech. So currently, there is estimate that roughly the price of entry-level bikes will increase by roughly 3,000 to 5,000 rupees. That's as per brokerage from Nomura, and that could impact the bike makers like Hero, as well as some impact on TVS as well, because they have a huge scooter portfolio which will also need these ABS systems. But in terms of beneficiaries, there will be two. One of them is definitely Endurance Tech because they already have an existing product, while the other one will be Ask Automotive, which derives 36% of its revenue coming from advanced braking systems and the braking vertical as a whole. So these two companies will definitely be in focus because as of now in India, roughly 75 to 80% of bikes do not have the ABS system. So with the confirmation of this news flow coming in from our sources, it is imperative that there could be a positive fillip on all these, or at least these couple of auto ancillary companies, and hence we've seen the positive reaction coming in on Endurance Tech today.
Okay, thank you so much for that, Puneet. Now, Sudeep, I have quizzed you about Auto Ank, Endurance, Ask Automotive. Any of those on your radar as a result of what's playing out here? Very quickly.
Endurance, definitely, because I think this will be a great opportunity for them. So incremental opportunity rather. So definitely Endurance.
Kush, do you have a view?
So Harsh, I think the move, at least because of this news trigger, is done. If you see the moves on Endurance and even on Ask Automotives, the stocks had actually seen some accumulations, in fact quite heavy duty accumulation over the last 5-7 odd sessions. And in fact, today are now seeing profit booking. Endurance also, if you see, is off the high point of the day from about 3,030 to 2,900 right now. And even our Ask Automotive had spiked up to about 547. yesterday, today seeing some profit booking. So on the back of this news, if someone wants to enter, I think it's time to book profits and take money off the table. But on the whole, from a medium-term perspective, the structure for both of these is rather solid. So if you do get an endurance take close to the 2775, 2800 mark, and even an Ask Automotive close to the 500 mark, you should consider a re-entry.
Okay. Well, what else? A third of a percent down for the indices by and large. Nothing too great. I think I was looking at stocks which might have moved in the session today in the last few minutes of trade. So EU Small Finance Bank and Federal Bank are amongst others which have had maybe a decent move for sure. On the Nifty Bank, of course, IDFC First Bank, something that Harsh highlighted in the opening show, has also done reasonably okay for itself. And which is why on the bull versus the bear segment, we focused on that one. Now, Harsh, interesting because it's not necessarily always had moves, but after doing that fundraise, if I'm not wrong, or a pref allotment or whatever they did at the price of 60, the stock has actually had a fairly decent return in the last 2 or 3 months.
It has, Neeraj, 25% from there, in fact more than 25% from there. So that seems to have been the bottom of sorts, at least for the moment. Let me not call it too quickly, but let's quickly pull up the bull versus bear. And the first point essentially is OPEX. OPEX has been elevated for IDFC First. Their cost to income is around 72%, which is quite high. Compared to peers, something like an HDFC has 40% cost to income odd. So that's quite high. Even if I look at it cost to assets perspective, it's 6%. So that's obviously elevated. And the last, in fact, when I'm looking at the 5-year period, cost to assets has been anywhere between 5 and 6% for an IDFC First. So it's quite elevated, but that also leaves it with a lever. If that were to come down, you'll immediately see an impact on profitability and ROA. And that's my first bull case. Can that change? But I've already kind of brought out the bear case here. The last 5 years, they're used to this very elevated cost to assets or cost to income. And that really is, they are finding it difficult to shrink that. At least that seems to be the case at the end of FY25 and what the commentary suggested. Now let's talk about the bull case on the second count. FY25 has seen a sharp spike in credit cost, 2.5%. Highest credit cost number since FY22 that we saw in FY25. That though is past us, and likely can we start to see a shrink from here is the question. And maybe there is, because Q4 there was a slight bit of shrink with regard to credit costs. Again, the question therefore is, the bull case question is the worst over? The bear case question is, could the pain continue? Let's go on to the third piece. Margins to be least impacted by the repo. This is basis the Investec note today, which I was going through. Margins among all private sector banks, IDFC seems to be the best place in terms of margins. They will protect their margins in this repo rate cut. But loan growth, which used to be elevated, 25, 30+% sometimes, has slowed down to 20%. You want to keep your eye out on that loan growth. Could it dip further? That could be a downside surprise if that were to happen with regard to IDFC First. Let's talk about valuations now. It trades at 1.4 times 1 year forward, which is in line with the 5-year average. So a positive, because you might see a cycle turn, right? You're at the bottom at this point, and you're at the 5-year average in terms of valuation, so not too expensive. Could you see an upside from here? Possibly, given the kind of valuation it's trading at. But it trades in line with competitors, so you could well see other competitors as well and compare valuations there. And if you're finding favor with another competitor, that could well be something that buyers will look at. Now let's look at how the analysts are looking at this. 15 buy calls, 5 hold, 5 sell. The average return is negative 5%. You want to look out for that. The stock has run up quite sharply. 73.58 is the average 12-month target price. Let me go across to Sudeep. Sudeep, do you have a view with regard to an IDFC First?
Oh, absolutely. We like the stock. In fact, even it was correcting post that preferential allotment, which they did. And there were a lot of negative publicity. We were positive. And we believe that 90 is the target for IDFC First at this stage. they have significant scope for improvement. And you're absolutely right. FY25 did see actually the worst possible credit cost and the scope for significant improvement, which is happening as the economy is improving. Also, the microfinance asset book, where they took a lot of hit, I think things are improving quite a bit there. Cost to income ratio is going to improve. That's what I understand from the management commentary in the last quarter meeting. So overall, we are positive. It's got a steady, stable management with a very clear focus on business. So we are positive here.
Okay, Kush, do you have a view with regard to an IDFC First?
First, from a momentum trade perspective, yes. I mean, otherwise the stock has been one that has disappointed the street, every now and then. But right now, if you see, it's got a few things going for it. There was a falling trend line, a falling channel resistance that it's broke out some time back, and it's building onto, those gains today. Also, you're seeing the stock up on the back of good volumes. I think from a near-term perspective, also you could look at an entry for targets of 81 once that to stick out and 85 as well. That happens to be a bit of a stiff resistance. So yes, from a momentum trade perspective, you could well consider IDFC First Bank and keep your stop losses near the 72 mark.
Okay, so but that's on IDFC First, one of the smaller banks. What's really doing well since the last couple of days, Neeraj, is the PSU banking space. And I'd be curious to know.
Today not so.
Today also is the top sectoral gainer.
BOB, etc. are slightly off.
Yeah, but it's still the top sectoral gainer today, and that's second consecutive day on the back of 2.5% that it did yesterday. Quite impressive. But let's listen in to a snippet of our chat with none other than Mr. C.S. Setty, who's the chairman of State Bank of India. We'll slip into a short break as well. On the other side, we'll take views. Also, I need to quickly thank both Sudeep and Kush for joining us this afternoon. Thank you.
The question of the margin is always something that is bothering a lot of people, especially in the rate cut cycle that we're in. And we're closing to the fag end is what we all understand that. But is that at all a worry for State Bank or for the chairman of the State Bank of India?
So the net interest margin trajectory is, in my view, would be a U-shaped curve, in the sense that in a couple of quarters we see the margins getting compressed.
Yeah.
Obviously, the front loading of repo rate has accelerated the repricing of some of the retail portfolio. For us, the benefit is that we don't have much of that repo-linked portfolio. Our portfolio is broadly either fixed or MCLR. But we want to give the benefit of MCLR reduction also to our customers, right? So which means that you need to calibrate your deposit rates. This is precisely what we have done. So going forward, I believe there are two things. One is the margins get adjusted, and number two, the September onwards, again an unexpected pleasant surprise from the regulator is to cut the CRR by 1%.
Yes.
So that will add, one is it will immediately reduce the cost of maintaining that reserve. And number two, ability to deploy those funds. So September onwards, I think there will be a addition to the margins. So we need to look at the exit margins of Q4.
Correct.
I think broadly most of us would be better positioned.
And it's a pride of the country. User friendly है. SBI के ऊपर सबसे ज़्यादा trust रहता है.
Wherever I am, even in the rural most areas, I still can find SBI.
Indian banking starts, and I would say even end with SBI.
This office has shaped the way State Bank of India thought about its role in the rural development, in supporting the MSMEs, in the industrial financing activity, both new age as well as conventional industries.
Imports become the exception rather than the norm. And increasingly we do almost, last year for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
Welcome back. Let's bring up a few stocks because there are some big moves happening in stocks or smart moves happening in stocks. Himmat Singha Seed is having a move, all right. So look at that move in that one in the last few. I believe Solara Active is the other one which is having a fairly sharp up move. Iris Clothing has a sharp uptick as well. Craftsman Auto, Equitas Small Finance Bank, Credit Access Grameen, ESAF Small Finance, a lot of stocks which are having some decent moves and sharp up moves in the last few minutes of trade. So keep them in mind. Our guests are with us for the last half an hour. Pankaj Pandey, Head of Research at ICICI Direct. Aditya Agarwala, Head of Research and Investments at Invest for EDU. Gentlemen, both of you, thanks so much for joining in. I rattled out a flurry of names, Aditya. I wonder, before we get to your calls, if you look at any of them, because they're all having some sharp moves in the last few minutes of trade.
Good afternoon, Neeraj. Oh, definitely. Most of them have been flying up and then flaring up as well. And if you take a look at the texture of the market, it has slightly changed towards smaller finance and NBFCs. Can add a couple of housing finance companies as well. And my sense is this space is going to see some more upside in the near term. I just joined the call. I was overhearing discussions on IDFC First Bank. Probably you can add a couple of more names to it. CUB, City Union Bank, that also is looking interesting. And a clutch of stocks that you mentioned, like Credit Access, Grameen and all. I think there is good opportunity in this space still. Talking of Credit Access Grameen, I still feel one can actually latch onto the stock even at current levels. There is good volume traction that we are seeing at lower levels from there. Stock has seen a good run up. I think there is more room on the upside. One can still go long in the stock. Look for a target of at least 1400 to about 1550 on the upside with a good support on the downside at 1150. So Credit Access Grameen definitely stands out for me. Talking about Himmat Singha Seed, this is one stock which is still stuck in a range, though from the lower levels it has seen some kind of a buying. Neeraj, I think 170 is a major hurdle for the stock. If it takes out 170, then maybe I'll be more interested in the stock. Apart from that, the one space that I really like are the smaller banks and few PSU banks as well, and NBFCs, if you can add it to that.
Got it. What about an index call itself? Are you doing something on the index itself, Aditya?
Not really. I think it will enter into a consolidation phase. There is a gap area which it witnessed in the month of October last year, 2024, which is closer to about 25,700. So my sense is markets will enter into a sideways consolidation for the Nifty between 25,400, 25,300 on the downside and 25,700 on the upside. Same holds true for Bank Nifty. It's actually heading into a resistance upper end of the rising wedge on the Nifty, Bank Nifty. Which is closer to about 57,700. So my sense is markets will spend into a sideways consolidation few more days, and then maybe you will see an eventual breakout, while you will see a churn in the sectors and the stocks that we are already witnessing.
Okay. What about ideas yourself, Aditya?
So I've got a couple of buy recommendations. One is from the metals pack, which is clearly looking very interesting. And I've picked up a Vedanta for our viewers. I think it's setting up for a big up move. So at current levels, I'll be a buyer. It's on the verge of a breakout from an ascending triangle pattern for a target of 500 with a stop loss at 450 on the downside. The second stock is from an EMS player. Again, this is one space which is looking very interesting. Sirma is something, Sirma SGX is looking very interesting to me, Neeraj. And I think a clutch of these stocks are looking interesting. I picked up Sirma as of now for a target of 635 on the upside with a stop loss at 560 on the downside. And there are more stocks within the space which I think can be looked at apart from Sirma only.
Okay. All right. So those are some views coming through with regard to some stocks. Let me quickly go across to Pankaj. Pankaj, if I were to ask you your top pick for the next year in terms of valuation as well as turnaround, what would that be? Can be a sector, can be a stock. Is there something in your mind?
So, a sector what we are liking for the next, say, 6 to 12 months or probably even longer is capital goods. I think post-budget, there was a sense that probably consumption is going to take center stage, but our sense is that when we look at the April numbers for central government CapEx or even the May numbers, I think those numbers are quite good. See, compared to last year, April numbers of nearly 1 lakh crore, this year time April, it was about 1.6 lakh crores. And again, from a low base of somewhere about 41,000 odd crores, now this number is about closer to about 60,000 odd crores. So I think capex is something which I feel is going to sort of make a comeback. I think all the entire ecosystem is sort of moving into that direction, be it RBI policy cuts or the kind of push what we are sort of getting from the government. What I'm clearly liking is again tier 2 names, especially for example, while a lot of bigger names are there, but I think the bearing companies particularly look interesting from the perspective that there has been a decent price correction there. We are seeing good amount of capex being planned by most of the players. And I think it's a basic industrial product. So whichever segment does well, bearing is going to be required. I mean, be it railways, be it any other segment. So I think so my topics again there would be Timken and SKF. And NRB Bearings is another stock which we've been liking for some time.
Okay. Wonder what Pankaj thinks of Dixon. We'll get to him on that and auto sales, because first let me get in Puneet, because Dixon Tech was under serious pressure and still down in trade because Morgan Stanley released a note downgrading the company. Puneet, tell us about the rationale here.
Well, thank you for that. It's not just on valuation. We've started seeing downgrades coming for Dixon on the business side of things, and that's where the concern slightly lies. Today, while they've upped the target price from roughly about 8,600 to 11,000, somewhat and change there, but specifically, they've gone on to say that they see a higher competition in the core EMS business, and that's largely continuing with what we've been discussing over the last couple of days, where some mobile volumes from Motorola, which is its largest client, has now gone to another EMS company, Carbon, and that could be under serious pressure post this year, where the PLI incentives end essentially by this FY26. So they've said that could be one of the key concerns. The second concern is on the component manufacturing side. They've highlighted that it is a step in the right direction for the company, but it could emerge as a business which was much tougher to execute compared to the traditional EMS business as well. And what's interesting is in terms of EPS as well, what they're estimating, while over the next 2 years, a 46% EPS CAGR is what the brokerage is estimating on Dixon Tech, that substantially falls to 18% between FY27 and 30. So therein lies the challenge. There could be some business from the EMS vertical going to other players, as well as the components business, according to Morgan Stanley, much tougher to crack compared to the traditional EMS business.
Okay, so that's the take coming in on a Dixon Tech. Pankaj, do you like EMS? And thank you for that, Puneet. And Pankaj, do you like EMS one? And within EMS, is Dixon one of your top picks, or how would you rate it?
So yes, EMS is a space we like. I think from 3 lakh crore plus, this industry is expected to witness 27% kind of a growth. And Dixon, within that is what we like besides Sirma. So in Dixon, we have a target price of 20,000 and Sirma about 640. We like both the companies because of the high growth prospects. I think on the Dixon, our sense is that see, from a manufacturer, from a OEM perspective, no OEM would want a single guy to sort of control too much of a volume. So a bit of a diversification, we don't see that as a strategic negative. In fact, our sense is that Dixon is going to remain the primary manufacturer for a lot of non-Apple phones. And overall sense is that we would be witnessing 35-37% or probably slightly higher kind of a growth both in the top line and bottom line. Bottom line could be higher because our sense is that with I think component or value addition going up, margin profile could improve from 3.9 to say about 4.5%. So we continue to like Dixon. We don't see anything major negative there. Sirma, I think, is more broad-based across other segments as well. So Sirma is another stock what we like. But we're liking this space. Only challenge is that because the growth rate is high, valuations are rich also.
Okay. Well, on a day of weak market breadth, it's good to know of pockets of strength as well. And of course, the weakness, of course, or the weaker hands need to be kept in mind too. So, well, on the strong side, of course, while Raymond has had a good one and banks have had a good move, in the EMS space, Amber Enterprises had a phenomenal move today, 4.5% in counting and trading at the day's high. So this is one serious mover. Non-EMS Blue Dart is now the top gainer on the Nifty 500. So you got to watch out for this as well. News and updates, more news and updates on to an NDTV Profit exclusive. New development in US-India trade deal. Tamanna joins us on the phone line. Tamanna, what are you gathering?
So, Neeraj, this is very interesting because even as the July 9th deadline nears, we know that there is now a stalemate which is continuing over trade talks in Washington between India and the US negotiators. And this stalemate is now because India is completely sticking to its red lines. This is what we are learning. In fact, the team is now once again extending its stay in Washington, D.C. And there was one extension which was yesterday. There will be one more. Where the whole conversation seems to be stuck is over two pockets. One is that the U.S. side is pushing for access to Indian agri and dairy sectors. And this is something that is not completely agreeable on the terms they want. India, on its side, we learn, is seeking concessions for labor-intensive sectors like leather and toys manufacturing, and that is the access that the Indian side is seeking for these sectors and this produce that comes from India. So even as we head to that July 9th deadline, even as President Trump is announcing that, we're very, very close to a deal. We heard from the White House this morning that there could be a deal anytime now. We are now learning that the stalemate very much continues as hectic negotiations are on.
Okay. Well, remember, thanks for that, Tamanna. Remember, there was an extension and one more, and the eventual date was supposed to be 30th US time, and now it is this. This is close to call, of course. Remember, 9th July is the flutter date, if you will, and it will essentially be a factor, Harsh, of the markets reacting in the run-up to that date and not necessarily on that date itself. And I think volatility could pick up, which is why I think Sudeep Bandyopadhyay was also mentioning that it might well be the case that because we've seen a bit of a run-up in the markets already, some smart money may want to take some chips off the table in that period, and then wait for your time. The markets have given you returns, take some money off the table, and then think of what to do next.
Okay, but Sudeep, so likely...
No, we have Pankaj, we don't have Sudeep anymore.
Oh, apologies. Pankaj, yes, you're right. So, Pankaj, would you also at this point look to take chips off the table? Is that what you're advising clients?
So our sense is that historically, say for example, July has been a very productive month for the market. It has on an average given returns about 2.5%. And I feel there are a lot of positives trigger which can sort of come in. Obviously, what we have clearly seen is that the crude oil prices have sort of have come down to nearly $68. On top of it, there is a good chance that probably some thing might come out of this bilateral trade agreement. Result season is expected to be okay compared to Q4, so you'll have stock-specific triggers. So we don't see, or we are not recommending people to sort of exit the market at this point in time. Our sense is that by another 3-4 months, we should be making a new high, and possibly levels like say 27,000 or 28,400 on the card technically in the next 3 to 6 months. So we're not advising people to sort of exit the markets or book profit at this point in time.
Okay, interesting. So stay put. That seems to be the case. Is there a case on technicals, Aditya, that one needs to be cautious at this point?
I would like to be a little cautious, Harsh. I wouldn't completely rule that out. A couple of reasons for that. If you take a look at the VIX, it's clearly hit the lower end of the bull territory. Whenever markets are in an uptrend, VIX usually tends to consolidate near 10 to 12 odd levels. We're almost there about 12.5 odd levels. Plus, if you take a look at the Nifty and the Bank Nifty, both are slightly at elevated levels, slightly at resistance zones as well, both on the Nifty and the Bank Nifty. So partial profit taking, yes, shouldn't be a bad idea. If you're sitting on decent profits, either on stocks or on indices themselves, it's not a bad idea to book partial profits at current levels, maybe about 40-50% of your profits. And look for some kind of a volatility to pick up when you will see a slight bit of cool off in both the indices. Then it will be a good idea to latch on to them again, because I don't see markets running away one way to new all-time highs just yet. It will take some time before you actually see that happening. So it might not be a bad idea to take some part of the profits off the table, at least 40 to 50%. And once you have some bit of a cool off in the market, a correction also, a good idea to re-enter.
Okay, all right. So that's the take, both fundamental and technical, and that's the big breaking you want to keep your eye out on. Will 9th July be positive for India, or at least the way it's going at the moment, basis information we're getting, not as much. But while we're at it, it's a day for autos, and while the auto index isn't moving as much, but we have Puneet here to take us through the June auto sales numbers that have come so far. Puneet.
Well, thank you for that. And it's very interesting because while most companies have met the weaker estimates, there have been a couple that have actually, underperformed severely, to say the least. Let's start with the two-wheeler names first. In terms is Eicher Motors. Now, the company's growth has been very strong in this particular month. 22% growth for the company. They've also beaten estimates handsomely in this particular month, and it's showed the highest growth. We're still awaiting numbers for Hero. It won't be close to 22% for sure, but it's a very strong number coming in for Eicher. The other one is Bajaj Auto, and here you see the growth differential from 22 of Eicher, just 1% for Bajaj Auto, and this also is largely led by the growth in exports. The domestic two-wheeler business has actually fallen 16% in this month, and it is a tough time because within the last 8 months, 7 months the company has reported a negative growth in the domestic market. So it's a serious need to look at that aspect as well. The other one's TVS, and again you will see a very sharp up move in growth, 20%. The product shown is rightly so because the scooter space has been doing effectively very well for TVS, as well as the higher premium bikes have been doing very well. So again, we've seen TVS as well as Eicher being key winners. In terms of four-wheeler space, and here is where you see the divergence again. Mahindra and Mahindra 18% growth in this particular month of June, and beating largely, almost meeting estimates as well. So it's been again a strong month. On the other side, when you look at something like a Tata Motors, and for the Harrier maker, they've shown a 15% YOY degrowth. While this could help in maintaining the inventory at a lower level, it's certainly a huge disappointment versus the estimates as well for almost 40,000 units. Finally, in terms of commercial vehicles and tractors, and we've seen a disappointing month for Tata Motors. Let's also quickly go to Ashok Leyland as well as VECV, because we'll see largely meeting estimates for both these numbers. Ashok Leyland as well meeting estimates, but the YOY growth is just between 1 to 3%. So it's been a month where it's been consolidation, and hopefully the second quarter is much better than the first one. And finally, in terms of tractors, Mahindra and Mahindra again showing a 13% growth, meeting estimates and beating estimates handsomely, while Escorts has largely just not met estimates that much, but 2% YOY growth, very low. So you're seeing three key winners again. Similar to last month is Eicher, TVS, as well as something like a Mahindra and Mahindra, and that could be continuing. Well, we're still awaiting numbers from Maruti as well as Hero, both big numbers within the key verticals, and those will be one of the key ones to watch out for tomorrow morning.
Okay, so that's with regard to auto sales which are coming through thick and fast. Thank you for that update, Puneet. I want to quickly take a BTST view from Aditya Agarwala before I take the auto update from Pankaj and take his views on auto. Aditya, BTST.
So I've got an SBI Life which looks interesting to me, Harsh, for a target of 1930 on the upside with the stop loss at 1810. It's a good BTST candidate.
And Pankaj, do you have a view with regard to the auto numbers and what do you make of it? What are the trends showing and what are you most bullish on within auto?
So on auto numbers, last few months, if you look at same template is getting repeated. The export volumes for most of the OEMs have been sort of doing good. I think in two-wheelers, clearly you have iShare, which is doing 90,000 kind of a monthly run rate, doing quite better, especially in the premium side. And TVS is doing a lot better compared to the other two counterparts. And in M&M, I think continues to deliver a high teen kind of a growth. Tractor is again expected to deliver a high single-digit kind of a growth. So no major changes. What we are liking in again auto is M&M with a target price of about 3,700. So that remains our top pick. I think iShare is another company which we like. So that is another pick. And I think overall sense is that in auto, one needs to be very selective because we are yet to see broad-based growth. So the benefit of tax cuts is really yet to sort of come by. And let's hope probably in 3 to 6 months whether we get something of that sort. Otherwise, I think, again, it will be led by only few select stocks. I am still not hopeful of a very broad-based pickup in numbers in this year in autos.
Okay, real estate has had an iffy last few days, but Kolte Patil in today's session is having a serious move. Then some very strong upticks in a stock called Quick Heal. So both of those will come up on your screen. Kolte Patil Developers and then Quick Heal. Quick Heal up 6.5% off in the last few minutes, but Kolte Patil 6.5% and trending higher and closing in at the day's high. So good going here. Aditya, in real estate, do you like or dislike anything? Because it's a sector that's underperformed in the last 6 or 7 days.
There are a few pockets which definitely look interesting, Neeraj, from within the real estate space. The one that stands out for us is Godrej Properties for sure. A good consolidation going on in the stock. I think a matter of time before it eventually breaks out of that hurdle of 2,500 and its levels of 2,650, 2,700 on the upside. The second is Shobha Developers. That is also something which we like within the real estate space. And after a good bit of a consolidation post-correction, I think it offers an excellent risk to reward even at current levels. Can be bought at the stop loss somewhere around 1450, 1440 on the downside. Look for a target of 1,800 on the upside. So there are a few pockets which do look interesting within the real estate space. Top two bets for us are Shobha and Godrej Properties as of now.
And Godrej Properties, point well noted. You know, the other one which has had a seriously good move, Aditya, the last few days is Laurus Labs. Now, should one take money off the table here, or are the charts looking good for more?
In fact, if anything, I believe stock has hit a new all-time high in trade today. And as we mentioned in technicals, if a stock is hitting a new all-time high, there are chances of stock continuing its upward momentum. Do not take money off the table. We are looking at a target of 850 on the upside as far as Laurus is concerned. If you are looking for a fresh entry, you can still take a fresh entry in Laurus Labs, I believe. Place a stop loss somewhere around 710 on the downside and look for a target of 850 on the upside. Definitely a hold and a fresh buy as well.
Not a cheap stock at all, right? But right, I mean, it's hit new highs today. So who's to argue against that? Fundamentally, is this or a Divi's or some other CDMO player something that you like?
On the CDMO side, obviously we like a big player like Divi's, I think. So that is the topic. Beside that, I think Piramal Pharma, our sense is that should benefit from the fact that they've got facilities in US also, and they're guiding for a good a low double-digit kind of a growth rate with a better margin profile over the next 4 or 5 years. So Piramal Pharma and Divi's is what we are liking in the CDMO space.
Pankaj, do you like the PSU banking pack at this point? We've had a couple of very good days for that one.
So within the banking, I think PSU banks are at a relatively slightly better position because last 2-3 years, I think they have not been losing market share. Credit growth has been quite decent for them. I think they are relatively less volatile from a margin perspective, given the fact that for PSU banks, I think 40-45% is external benchmark linked rate. On top of it, they're well placed on CASA front, and even on the valuation front, I feel that they're relatively better placed. What we like in PSU is again something like, say, Indian Bank. It has got one of the best ROAs of about 1.3%. Besides that, I think Bank of India and PNB is another the other two stocks what we like. SBI, I can't comment.
Okay. Aditya, do you have a view?
Oh, definitely, Harsh. In fact, as a disclosure, we have recommended PSU banks to our client in the past 2 trading sessions. The top 2 bets would be SBI and a PNB. For SBI, we're looking at a target of 860, 880 on the upside. Place a stop loss at 810 on the downside. As far as PNB is concerned, that too we have recommended and would be in their positions for a target of 120 on the upside with a stop loss at 110 on the downside. PNB Bank also looks interesting. And my sense is the next leg of rally within the banking space will be led by PSU and the smaller banks as we've been talking about.
Okay, just before we start wrapping up the markets, 3 minutes left. You got to wonder what's happening to Coromandel International, because that stock has really sunk in trade today, right? I don't know if this is ex-dividend or otherwise, but some very sharp downtick in trade today. Aditya, any thoughts here? It's usually not a stock that's prone to such sharp moves.
Absolutely right, Neeraj. In fact, it's also heading very close to support levels of 2270 on the downside. I won't look at exiting the stock just yet. If you already hold the stock following this 7% downtick that we're witnessing, maybe see how the stock behaves around 2250, 2270, because that happens to be a major support for the stock. It's more of a consolidation we are witnessing between 2500 and 2270, 2250 on the downside. If it breaks 2250, then I'm looking to exit the trade. As of now, I would not be too much in a hurry to exit the trade, because I'm not seeing too heavy a volume also in selling as we had seen in the buying previously.
And Aditya, very quickly, Blue Dart and Raymond in particular, because surprising moves there, I thought.
Oh yes, Blue Dart is something which also popped out for me while I was looking at scanning stocks. The only thing here I'm waiting for, and I'll watch for trade tomorrow, is it's heading to its 200 DMA. Once it breaks out of 200 DMA, then I'll be a buyer in the stock. Above 6950 is where I'm looking at going long. If it breaks out of 6950, then I'll be a buyer in the stock. As far as Raymond is concerned, yes, this is one stock which will continue to head higher. I believe 850, 900 on the upside in Raymond is a very much possibility. If you already have it, continue to hold. If you're looking at fresh entry, you can again go ahead and buy the stock even at current levels with a stop loss at 720 on the downside. Look for a target of 850 to 900 on the upside.
Pankaj, very quick 20-second view on Raymond. Are you positive?
Don't cover this stock.
Okay. All right. Thank you so much, gentlemen, for joining us this afternoon. We'll let you go on that note. We're a minute away from close. Let's quickly look at how the Nifty is shaping up at close. We're just about on the flat line. 25,500 held, second day in a row. Not bad news at all. Let's look at the intraday chart on the Nifty. We're off the highs, of course. We made a high of 25,593, but it's a fairly range-bound session. You look at the low, you look at the high, just 90 points between that. And therefore, it's been a very, very range-bound session. But we're closing in the green as we speak. So nothing to complain about in that sense. Let's look at the heat map and let's see what pockets have done well. Apollo Hospitals, no surprise there, 3.5% higher after that announcement. Well, defense continues to do well. BEL 2.5% higher. Reliance, the big boy, has done 2% as well, and that kind of aids the index as well, right? What's not done well? Well, you have Nestle as one pocket, and some consumer, including an Eternal, is sinking around 1% or so lower. Let's look at the contributors as well. We've closed for the day. The breadth largely even Steven on the Nifty, but Reliance, HDFC, Kotak, likely that's what's really in some form or shape aiding the index. What's putting pressure? And ICICI Axis. So it's the private sector banks which are really playing both positive as well as negative on the index. That's of course the breadth, and overall it was absolutely neck to neck, 1:1 at close, but there was plenty of gyrations all through the day that we've seen. Let's look at the mid cap and small cap indices as well, and that'll give us a sense. The broader end largely flat on the Nifty mid cap at close. The Nifty small cap as well, just about a 1/5% lower, so no action per se in a big fashion. Again, fairly range bound in the way they've traded as well. Let's also look at the BSE 500 top gainers, top losers. Before I just look at sectors very quickly, some names which we've spoken about pretty much over the last hour and a half of trade. But an RBL Bank is the other one that really stands out. Second straight day of gains, and look at that, nearly 5% higher for an RBL Bank. And those are some big losers. Coromandel sitting right up on top. Obviously, volumes is what's likely led to that, because otherwise very little in terms of an explanation as to why that is 7% lower. Let's look at sectors now very quickly. What you're seeing is PSU banks continue to do well. Defense also 0.5% higher. Quite a good day for defense in relative terms. 1/3% higher on metals. What's not done well is an FMCG. We spoke about that a bit. Nifty IT also down around 1/3% thereabouts. The Nifty Realty was down around 1/4%, but largely no major moves on sectoral indices. Frankly, in terms of what to watch, far and few for tomorrow. So those are some things that you'll want to keep your eye out on globally, but outside of that, very, very little to speak about. US manufacturing PMI is the other one. Fed Chair Powell's speech will be interesting because of all that's happening between the US administration and the US Fed. But for the moment, from Neeraj, myself, everyone who puts the show together, thanks so much for watching. Out of time on this one. Market Express will take all the action forward. Stay tuned.
and it's a pride of the country. यूजर फ्रेंडली है. SBI के ऊपर सबसे ज़्यादा ट्रस्ट रहता है.
Wherever I am, even in the rural most areas, I still can find SBI.
Indian banking starts, and I would say even end with SBI.
This office has shaped the way State Bank of India thought about its role in the rural development, in supporting the MSMEs, in the industrial financing activity, both new age as well as conventional industries.
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold ICICI CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and invest wisely.
Your portfolio, your future. Ask Profit.
Do you really know the company you invest in?
and welcome. You're watching Market Express and I'm your host Himakshi Bahugna. Now let's get straight to the show, viewers. Benchmark indices outperformed broader markets today. Both Nifty and Sensex ended about 1% higher, while the Nifty wrapped up trade above 25,500 levels. The 30-pack Sensex stood above the 83,600 mark. Heavyweights like Reliance, HDFC Bank and BEL added to the momentum. On the other hand, ICICI, Axis Bank and TCS also added pressure. Benchmark indices outperformed broader markets. Both Nifty and Sensex ended about 1% higher, while the Nifty wrapped up trade above 25,500 levels. The 30-pack Sensex stood above the 83,600 levels. Heavyweights like Reliance, HDFC Bank and BEL added to the momentum. On the other hand, ICICI, Axis Bank and TCS added the pressure. Most sectors, viewers, ended in the red, with media, FMCG and IT being the top laggards. Meanwhile, PSU Bank's defense and oil and gas lead the gains, ending the day in the green. Apollo Hospital was a buzz in trade after the company decided to hive off 3 of its business into a separate company. The new company will be listing directly on stock exchanges and the transaction will be completed in 18 to 21 months. Now, the combined entity aims to hit 16,300 crore rupees in revenue by FY25 and plans to top 25,000 crore rupees revenue by FY27. Now on to the brokerage verdict on this demerger. Morgan Stanley maintains an overweight rating on Apollo Hospitals with a target of 7,242 rupees, citing potential value unlocking. They note Apollo trades at a discount to peers, sees its NewCo as India's largest omni-channel pharmacy distribution company. Morgan Stanley also praised its aggressive revenue and EBITDA targets that could actually boost shareholder value. Meanwhile, Citi remains bullish, maintaining a buy rating. They view the demerger and the listing of its pharmacy and digital health business as positive. They also expect the move to narrow Apollo's 25 to 30% discount to peers through a leaner business structure. Morgan Stanley has downgraded Dixon Technologies to underperform from equal weight. Now, the brokerage has raised its target price to 11,563 from 8,696 rupees. Now, the downgrade comes as analysts see increased competition in Dixon's core electronics manufacturing services business. They also view the company's move into component manufacturing as a positive step. However, Morgan Stanley has cautioned that it could be more challenging to execute than its core operations. CG Power, an industrial solution, has launched a qualified institutional placement to raise up to 3,000 crore rupees. The issue price is set at 660 per share and 3.25% discount to last closing price. The floor price was set at 679 rupees. The QIP, which opened on June 30th, will result in a 2.89%, close to 2.9% dilution of the company's post-issue equity capital. The funds are also aimed at strengthening CG Power's balance sheet and supporting its growth in industrial systems, power solutions and consumer appliances. Kalpatru Projects and its subsidiaries have secured new orders worth 989 crore rupees in the power transmission and distribution sector. Now, this is largely from the overseas markets. This brings the company's order intake for FY26 to 7,150 crore rupees. Now, this signals growth visibility. Meanwhile, Manish Monot, the company's MD and CEO, highlighted that strong traction in the T&D business. This traction was actually driven by global demand for grid infrastructure. The order win also powered a 4% uptick for the stock. However, the stock pared some of its earlier gains and ended the day in the red. ESAF Small Finance Bank has completed the sale of stressed loans worth 733 crore rupees to an asset reconstruction company, receiving 73 crore, a 10% consideration of the outstanding amount. The portfolio finalized via the Swiss challenge method includes 362 crore rupees in the non-performing assets and approximately 373 crore rupees in the technically written off loans with 90.15% provisioning coverage. Now, this strategic move aims to clean up the bank's balance sheet, improve the asset quality and bolster investor confidence as ESAF focuses on strengthening its core lending operations. Shares also rose over 3% today following the announcement. IRDA's Q1 of FY26 update shines with a 19% year-on-year increase in the loan sanctions and a robust 31% rise in disbursements, outpacing its lending peers. Recently raised funds have bolstered its capital adequacy, ensuring growth capital availability. Meanwhile, HUDCO reports a strong Q1 of FY26 with loan sanctions soaring to 33,904 crore rupees from 14,097 crore rupees year-on-year. However, loan disbursement remained flat at 12,812 crore compared to 12,625 crore rupees on a high base, still contributing to AUM growth. Now, both companies signal resilience in their financing strategies. In some major relief for Yatharth Hospital's Ramraja Hospital's land, the dispute in Madhya Pradesh has been conclusively resolved. The company's rightful claim to the land was confirmed. The issue arose when Sagar Sambhag ordered a takeover claiming the land belonged to the government. Ramraja had challenged this in the Madhya Pradesh High Court, which directed the commissionerate to reconsider. Meanwhile, hospital operations remain unaffected throughout, ensuring uninterrupted patient care. Gabriel India managed to hit 20% upper circuit after the company announced plans for strategic restructuring. The plan aims to transform the company into diversified mobility solution provider. The plan also aims to consolidate all auto businesses under Gabriel India. Hindustan Copper and Coal India have signed a memorandum of understanding to jointly explore and evaluate opportunities in the copper and critical mineral sector. This partnership aims to identify potential projects and explore collaborations with renowned global companies in these fields. While the MOU is non-binding, it marks a strategic move for both state-owned firms to strengthen their presence in critical minerals, vital for India's industrial growth and energy transition. Hexacom Telesystems Board has approved a rights issue to raise 260 crore rupees by offering equity shares to existing shareholders, aiming to strengthen its capital base. The company currently holds cash reserves of 220 crore rupees but carries a debt of around 700 crore rupees with a market capitalization of 2,387 crore rupees. Hexaware Technologies has approved an additional investment of up to $50 million, approximately 430 crore rupees, in its wholly owned subsidiary based in the United States. Now, this investment planned to be made by the end of 2026, which will be in the form of equity share capital or other instruments. Prestige Estates launches a new premium residential project in Chennai spread over 21.84 acres. The development features 2,069 high-end apartments in 2 to 3 and 4 BHK configurations with a gross development value of 3,350 crore rupees. Located on the Pallavaram Thorai Pakkam Radial Road, the project offers excellent connectivity to key commercial and its hubs along with top educational and healthcare facilities. Bharat Electronics has disclosed receiving additional orders worth 528 crore rupees following its last update on June 20th. Now, these new orders include advanced radars, communication equipment, electronic voting machines and jammers. Now, the fresh business reflects BEL's continued strong demand from defense and government sectors, reinforcing its position as a key player in India's strategic electronics manufacturing. Jefferies and Investec have both maintained a buy rating on Ambuja Cements, highlighting strong growth prospects. Jefferies has set a target price of 700 rupees, noting that the company is ripe for a comeback after a challenging fiscal year 2025. The management's strategic focus on cost efficiency, capacity expansion and technology adoption is expected to drive a sustained turnaround from Q4 onwards. Now, Ambuja is considered one of the top picks in the cement sector. Meanwhile, Investec has a higher target of 836 rupees, emphasizing management's commitment to capacity targets and cost efficiencies with a FY28 EBITDA per ton target of 1,500 rupees. CLSA maintains a high conviction outperform rating on DLF with a target price of 1,025 rupees. The brokerage praises DLF's restrained aggression and strong governance in managing supply, pricing and capital allocation. DLS calibrated strategy focuses on balanced pricing and supply management alongside prudent capital management that has successfully lowered debt and avoided equity dilution. Mahindra Electric is paving the way for a potential IPO as key investors Bain Capital India and Temasek plan their exit between fiscal years 2028 and 2031. Both had invested 3,050 crore via convertible shares, with Bain Capital expected to hold a stake between 2.6% and a 4.6%, and Temasek between 1.5% and approximately 3%. Now, these investors aim for a full exit at valuations above fair market value, either through cash or share swaps. In international trade news, the US and India are nearing a mini trade deal, but it may offer only limited tariff cuts. Sources tell NDTV Profit that the agreement is unlikely to include sector-specific reductions. There is likely to be no relief expected on duties for autos, auto components, steel, or aluminium. Instead, the focus is on reciprocal tariff reductions or the removals. India warns that doubling bilateral trade will be challenging without broader tariff cuts. India has also urged both nations to prioritize lowering overall trade barriers. Talks continue as the two countries aim to strengthen economic ties. 65 IPOs have hit the Lal Street in 2025 so far, with 22 main board and 43 SME IPOs listed. 35 IPOs saw gains on their listing day, while 25 faced losses. Notably, 6 of the 22 main board IPOs are trading below their issue price, and 27 of the 43 SME IPOs on BSE are also underwater. Despite some strong debuts, posts on X highlight a tepid trend, with over half of recent listings trading below their IPO prices, signaling mixed investor sentiment in India's primary market. Raymond Realty made its market debut, listing at 1,005 rupees on the BSE and 1,000 rupees on the NSE. So the stock has gained 6% since its initial listing. With this move, Raymond adds a second independent growth engine to its portfolio. So the company had already successfully executed the demerger and listing of its lifestyle business through Raymond Lifestyle, unlocking significant value. The listing of Raymond Realty is expected to follow a similar trajectory, reinforcing the company's strategy of creating focused standalone entities to drive long-term shareholder value. Kalpatru shares hit the bosses for the first time at 414 rupees on the National Stock Exchange, which means that's a flat listing. Kalpatru IPO, which opened its bidding from June 24th to June 26th, saw good response, especially from the non-institutional investors. By the end of day 3, the issue was subscribed to 2.3 times in total. Globe Civil Project shares listed at 27% premium on the National Stock Exchange on July 1st, following a bumper subscription of 86.03 times in the primary market between June 24th and 26th. So shares of Globe Civil Projects were listed at 90 rupees per share on the NSE, a premium of 26.7% over its issue price. So the 119 crore rupees initial public offer had a price band of 67 to 71 rupees a share. So the total market cap of the company post-listing shares stood at 536 crore rupees. The Transport Ministry's proposal to mandate ABS on all two-wheelers from January 1st, 2026 will impact entry-level bikes, which make up 76% of the sales. This could raise prices by 3,000 per vehicle, with Nomura estimating a 2 to 4% sales hit. Hero MotoCorp, with over 80% of FY25 sales from entry-level models like Splendor, faces the biggest impact, while Bajaj and TVS with 10 to 12% entry-level contribution are less affected. Auto component makers Endurance Tech and Ask Automotive stand to benefit, with the Endurance expanding into dual channel, ABS and Ask deriving 36% of revenue from ABS systems. Oil marketing companies have slashed the price of 19 kg commercial LPG cylinders by 58.5 rupees effective today. marking the 4th consecutive monthly reduction in Delhi. The retail price is now 1665 rupees, down from 1723.5 rupees. So Mumbai sees cylinders at 1616 rupees, Kolkata at 1769 rupees. Domestic 14.2 kilogram cylinder prices remain unchanged at 853 rupees in Delhi. So this cut, driven by softening global crude prices, offers relief to hotels, restaurants and small businesses, though aviation fuel prices rose 7.5%. So GST 2.0 rate rationalization may actually further impact future pricing. Putting all speculation to rest, the Congress High Command today made it clear that it has no plan to replace Siddaramaiah as the Karnataka Chief Minister for now. Deputy Chief Minister D.K. Shivkumar, whose supporters have been demanding his promotion to the top post, sat next to senior party leader Surjewala as he made the announcement. The Telangana factory blast has reportedly claimed 36 lives as rescue operations recovered more bodies today. The toll, which was 12 till Monday night, rose to 34 this morning and is now at 36 after multiple reports gave varying figures. Officials are currently verifying whereabouts of the missing people. A suspected reactor explosion triggered a blast and fire at the Sigachi chemical industry on June 30th. Prime Minister Narendra Modi is all set to begin his 5-nation tour from July 2nd to July 9th. Now, this tour, which will begin from Ghana, will mark the Prime Minister's longest diplomatic visit in nearly 10 years. PM Modi's 5-nation tour will focus on South American, Caribbean and African countries. Now, the final leg of the tour will take place in Namibia, which will also mark the first visit by an Indian Prime Minister in 27 years. Donald Trump takes another hard jibe at Elon Musk. Trump has suggested his administration to look into cutting subsidies to Elon Musk in order to save the government's money. So now this is in retaliation to Musk's sharp criticism for Trump's multi-trillion-dollar tax bill. Trump warned on social media, saying that without subsidies, Elon would probably have to close up shop and head back home to South Africa. No more rocket launches, satellites or electric car production, and our country would save a fortune. The US Senate is in a heated marathon voting on the One Big Beautiful Bill Act, a 1,000-page budget crucial to President Trump's agenda, facing a July 4, 2025 deadline. Republicans controlling Congress are split on welfare cuts to extend tax breaks, with the bill adding $3.3 trillion to the $36 trillion national debt. $36 trillion national debt. Now, Elon Musk, once Trump's ally, called it insane, threatening to challenge the GOP supporters and form a new party. Trump countered, hinting at cutting Musk subsidies via DOGE. A Medicaid amendment by Senator Rick Scott risked $20 million losing health care. The bill needs Senate approval and a House re-vote after passing by one vote last month. Thailand Prime Minister was suspended due to her conduct in a diplomatic spat with Cambodia. The suspension follows a case being lodged by a group of conservative senators accusing the PM of breaching ministerial ethics during a border row with Cambodia. As per a leaked recording, when the PM called Cambodian statesman Hun Sen to discuss tensions, she referred to him as uncle and called her own country's military commander an opponent. Conservative lawmakers argue that she breached constitutional provisions requiring evident integrity and ethical standards among ministers. A powerful heat wave grips Western Europe today, putting Paris on red alert as temperatures soar above 40 degrees Celsius. French authorities open cooling centers and urge residents to stay indoors and hydrated, especially the elderly and vulnerable. Meanwhile, parts of the UK brace for possible highs of 35 degrees, prompting health warnings and travel disruptions. Across Europe, countries like Spain, Italy and Germany also experienced record-breaking heat, with wildfires reported in some regions. India's Smriti Mandhana has soared to a career-best third place in the ICC Women's T20I batter rankings with 771 rating points following her maiden century, 112 of 62 balls, against England in Nottingham. She trails West Indies' Hayley Matthews and Australia's Beth Mooney. Mandhana's knock powered India to a 97-run victory, the largest T20I defeat for England by runs. MS Dhoni's application to trademark his famous nickname, Captain Cool, has been officially accepted by the Trademarks Registry. The title, which reflects Dhoni's calm and composed leadership on the cricket field, will now be exclusively associated with him for sports and related services. The trademark was published on June 16th of 2025 and will be formally granted if there are no objections in the next 120 days. Well, with that, viewers, it's a wrap on Market Express, but please stay tuned to NDTV Profit as Sanjana Chauhan brings you Profit 360 on the other side of the break.
And it's a pride of the country. यूजर फ्रेंडली है. SBI के ऊपर सबसे ज़्यादा ट्रस्ट रहता है.
Wherever I am, even in the rural most areas, I still can find SBI.
Indian banking starts, and I would say even end with SBI.
This office has shaped the way State Bank of India thought about its role in the rural development, in supporting the MSMEs, in the industrial financing activity, both new age as well as conventional industries.
Imports become the exception rather than the norm. And increasingly we do almost, last year for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and
Benchmarks end higher, outperform broader markets as the Nifty Midcap 150 snaps its 7-day winning streak. Meanwhile, sectoral indices end mixed with the Nifty PSU banks ending as the top gainer. Sources tell NDTV Profit that the stalemate persists in the India-US trade talks, with Indian negotiators extending their stay in Washington as both sides remain entrenched on key issues. SBI plans to become a financial superstore. That's the word coming in from SBI Chairman C.S. Sethi, adding that private capex boom is some time away. An NDTV Profit exclusive lined up on the show. Quick commerce companies in India add various fees like handling, convenience and now rain charges to customer orders to improve their unit economics amidst rising competition. Saraswat Bank set to acquire the beleaguered lender New India Cooperative Bank. This after New India was placed under restrictions by the RBI in February. The death toll in the Sigachi Pharma Industries explosion in Telangana's Sangareddy district climbs to 36. Meanwhile, shares of Sigachi Industries extend their plunge by another 8% a day after the incident. In a bid to curb pollution, Delhi bans fuel for end-of-life or overage vehicles that include 15-year-old petrol vehicles and 10-year-old diesel vehicles. Good evening, you're watching Profit 360 on NDTV Profit. I'm Sanjana, and for the next 30 minutes, we're going to bring you the latest on markets as well as national and international news. So let's jump right into it and have a look at how the markets fared today. Nifty and Sensex ended flat after a choppy day of trade, but outperformed the broader markets. Meanwhile, sectoral indices ended mixed. But let me go across now to my colleague Harsh for a wrap of the day's market action. Harsh, over to you.
Well, we've closed absolutely flat on the Nifty 50 index. The positive here is two things. One is that we've at least not corrected significantly after the rally we've seen. That's point number one. Point number two, extremely range-bound day of trade that we've seen today. We traded in a less than 100-point band, and we've closed above 25,500. So that's the lowdown with regard to the index itself. When you look at the breadth of the index as well as the market as a whole, largely even Steven. 24 advances to around 26 declines on the Nifty 50, and just about 1100 advances to a very equal number of declines on the NSE as a whole as well. So largely even Steven where the breadth is concerned. The broader markets, well, they inched slightly lower, so we saw maybe a 50% lower on both the Nifty mid-cap as well as small-cap indices. But again, nothing too major in terms of a reaction, and that's a positive. In terms of sectors, again, nothing that really stands out. We had a couple of sectors doing okay. PSU banks continue to rule the roost. They're top gainer, along with Nifty India Defence among the losers. Of course, we saw some bit of pressure with regard to metals as one of the sectors which saw some pressure. But outside of that, you didn't see too much from any of the other sectors, and that's again a positive. The Nifty Auto Index in focus because of auto sales numbers, a 50% lower is where that one has closed. When you're looking at specific names that have moved, yes, there were a few names zooming, and that will come shortly on your screen. But broadly, again, the market looked quite decent given the kind of rally we've seen. We're seeing a bit of consolidation at play at this point.
Meanwhile, Prateek Agrawal, MD and CEO of Motilal Oswal AMC, explained which sectors he believes will be and give good growth in the month of July. Let's listen in.
Our house would be expected to be invested into something like NBFCs, but a lot of these new spaces and all of them happening together at the same time, to our mind, never happened before, are these spaces which offer growth in earnings significantly higher than that of the index. I mean, a lot of these spaces are small, so they are not held back by the size of the economy and the economic growth. These are the spaces which are driving the next $1 trillion expansion of the economy. And we believe these spaces held for a long period of time in a portfolio, not space per se, could deliver good outcomes for the investors. Frankly, we have been doing this for now 2.5 years.
And moving on to some crucial information coming in with regards to India-US trade talks. Sources are telling NDTV Profit that the stalemate over the trade talks continues. We understand from these sources that India is sticking to its conditions in the trade negotiations. The team, if you're aware, has extended its stay in Washington. But my colleague Tamanna now bringing us the latest.
This is very interesting because even as the July 9th deadline nears, we know that there is now a stalemate which is continuing over trade talks in Washington between India and the US negotiators. And this stalemate is now because India is completely sticking to its red lines. This is what we are learning. In fact, the team is now once again extending its stay in Washington, D.C. And there was one extension which was yesterday. There will be one more. Where the whole conversation seems to be stuck is over two pockets. One is that the US side is pushing for access to Indian agri and dairy sectors. And this is something that is not completely agreeable on the terms they want. India, on its side, we learn, is seeking concessions for labor-intensive sectors like leather and toys manufacturing, and that is the access that the Indian side is seeking for these sectors and this produce that comes from India. So even as we head to that July 9th deadline, even as President Trump is announcing that, we're very, very close to a deal. We heard from the White House this morning that there could be a deal anytime now. We are now learning that the stalemate very much continues as hectic negotiations are on.
Right, remains to be seen now how these negotiations and conversations move further now that India is actually sticking to its ground and digging its heels in when it comes to these India-US trade talks. Moving on, here is a snippet of our chat with none other than the SBI chairman C.S. Setty, who addressed some key concerns about rate cuts and the margin impact. He reveals how the recent CRR cut will ease reserve costs and signal margin improvements from September. Let's listen in.
The question of the margin is always something that is bothering a lot of people, especially in the rate cut cycle that we're in. And we're closing to the fag end is what we all understand that. But is that at all a worry for State Bank or for the chairman of the State Bank of India?
So the net interest margin trajectory is, in my view, would be a U-shaped curve, in the sense that in a couple of quarters, we see the margins getting compressed.
Yeah.
Obviously, the front loading of repo rate has accelerated the repricing of some of the retail portfolio. For us, the benefit is that we don't have much of that repo-linked portfolio. Our portfolio is broadly either fixed or MCLR. But we want to give the benefit of MCLR reduction also to our customers, right? So which means that you need to calibrate your deposit rates. This is precisely what we have done. So going forward, I believe there are two things. One is the margins get adjusted, and number two, the September onwards, again, an unexpected pleasant surprise from the regulator is to cut the CRR by 1%.
Yes.
So that will add, one is it will immediately reduce the cost of maintaining that reserve. And number two, ability to deploy those funds. So September onwards, I think there will be a addition to the margins. So we need to look at the exit margins of Q4.
Correct.
I think broadly most of us would be better positioned.
And let me quickly cut across to Tamanna now, who is actually going to bring us more on the JSW AkzoNobel deal, speaking with the MD. Over to you.
It's because the paints business has been heating up. New entrants, big entrants, and of course, a new player in town now. Parth, let me start with how you managed to chase down this acquisition, because we know the #1 market share company was looking out at AkzoNobel, so was #2, so were several others, but you finally got them here at the end.
Yeah, so we entered the market in 2019, and we've been one of India's fastest growing paint companies. We clocked a revenue of more than 2,000 crores last financial year. And we have always aspired to get to and become like certain brands. And Dulux has been one of those aspirations. Even when I was studying in college and when I was working on the project of, which is the next business the JSW group should enter, and I zeroed in on paints, one of the brands which were the aspirational category was obviously globally was Dulux, and even in India. So when AkzoNobel Global announced their strategic review last year in September, we felt that this was too good an opportunity not to really go for, not to really fight for. And when we looked at the synergies, both on the decorative side of the business, as well as on the liquid coatings industrial side of the business, we felt that the two businesses of JSW Paints and AkzoNobel India were highly complementary in nature. And that's why we said that, if we truly want to become a top 3 player in this category, if we truly want to gain size and scale fast, and we truly want to operate like JSW operates in other businesses, then this is the natural partner for AkzoNobel India. So, we really worked hard on it. I went and met Greg in Amsterdam and introduced myself. He knew of the family because he has worked in India for many years in various different companies. And we struck a deal, and I think it's a deal that is mutually rewarding for both players, and it really gives JSW Paints now the heft, the might, and the power of the brand of not only Dulux but also International, also Sikkens, also Wanda, and truly gives us the ability to leverage their international R&D capabilities and know-how, and our know-how on India, and really get a marriage that hopefully can take us to the next level.
Greg, I want to hear your version of this story, because there were a lot of suitors, and finally Parth has clinched that deal. JSW Paints has got you there. What was in that particular pitch that worked for you? What was the winning proposition?
Well, first of all, it's a wonderful partner. It's a family whose name speaks for itself, and JSW as a group is a wonderful success story. But beyond that, it's true that we talked to a lot of people and that there were a lot of parties interested. But at the end of the day, what made the difference is that Parth has a clear vision. He's got a very supportive family with a clear governance that allows him to be agile and to move quickly. And then we share the same values, so it was an easy decision.
You talked about how even when you were in college, the paints business is something that you had identified. And I'm just going to pick on that part, because right now, and we saw that in the last financial year, but right now, if you just zoom out and look at what's happening with the paints business in India, it's hit a bit of a rough spot. Discretionary spends have not quite kept up, and at the same time, there's competition heating up. So it's a great acquisition, but it is a bit of a tough time.
Yeah, so I think if you look at the paints industry in general, there are two segments of it, right? There's the decorative segment as well as the industrial segment. Now, last year was an anomaly where the decorative industry was flat. And we saw the largest players in the space actually lose market share, and the newer entrants like us and others gain share. But overall, the industry was flat, and the decorative industry has been growing at a CAGR of 10 to 12% for nearly 2 decades. So it is bound to have a couple of years here and there of flat growth. And last year can be attributed to the general election. It can be attributed to a lot of state elections, which led to government spending also slow down. We're hopeful that comes back. Industrial, on the other hand, had a very strong year, and as India industrializes, as India tries to become the manufacturing hub not only for our domestic demand but also for global, industrial will continue to see growth. And what really excites me about this opportunity is that we have two engines of growth. We have the decorative engine of growth, which, like you rightly said, has hit a rough water. There is intense competition, there is increasingly stiff competition. And then there's the industrial coating side of the things, where we are now the number 2 player. Between ANIL and JSW Paints, we become number 2. And we have a clear pathway there how to leverage their global technology and know-how and our B2B relationships to go to number 1. So we are very confident that the sum of the two companies coming together will allow us to take this company to the next level.
It's also a deal at great valuations. When there were, the back of the book calculations being made over the last several months of what AkzoNobel would go for, the number was significantly higher, or maybe that was priced in your stock as well, than what you ended up at. So what was the key consideration there? Of any of light you can throw on that aspect from either of you?
I think the math confuses people, which is often the case. You're talking about a publicly traded entity, AkzoNobel India Limited, of which we're taking out the powder business. So there's a split. And then we're putting in some of the IP, and then we're taking out the research center, and then we're taking out a dividend. So anybody that makes a straight comparison between the share price and the value announced is either a visionary or a math genius. But the reality is that it's a fair deal for both parties.
They're both of those, visionaries and math geniuses trading in the market.
Especially in India, there's a lot of math geniuses, but it's...
No, because that's what, I mean, that was what was being priced in by investors, etc. So that was a bit of a question when the deal was announced. You saw that in the stock price on day one, but of course it evened out. But you're explaining it well, that there is a whole bit that you retain, and you retain your presence in India as well, right?
We do. Lots of ins and outs, and at the end of the day, I think Parth will agree that we both got what we were looking for out of this. They got a great business. We got what we think is a fair valuation and a long-term partner, because we will be the technology provider under a royalty agreement for the coating businesses, and therefore we're together for the long term.
So what you get out of this, of course, is the brand, the Dulux brand, and of course the technology, etc. How do you now leverage on that part in a space which has become extremely competitive? What there is the cutting edge? Because you have, for example, the number one player who I think has 5x of the distribution touch points of the number 3 player, 4x of the number 2. How do you now plan to move ahead in a space like that?
Yeah, sure. So on the decorative side of things, AkzoNobel India, which is Dulux, has about 19,000 retailers across the country, 19,000 machines, tinting machines installed, and JSW Paints has about 9,000. So when we put the two together, we have about a 10% overlap. So we get to about 27,000 machines in the market. So one, there is huge synergy to unlock amongst these 27,000 in itself, because if you look at Dulux, Dulux is the leading player when it comes to premium paint, luxury premium paint. Dulux is known for that, and they have a disproportionate share of their business as well as a disproportionate share of the market of luxury is with Dulux. When you look at JSW Paints, we are one of the fastest growing companies in the value segment as well as in the mass premium segment. And hence, our 9,000 retailers will now get access to the Dulux products. Their 19,000 Dulux retailers will get access to our value and mass premium. And here we will be able to increase the share of business in each of these counters. This in itself will unlock huge amounts of synergies. Second is, if you look at the geographical presence of both companies, although both companies are pan-India, Dulux is very strong in metros and in tier 1 and tier 2 towns. JSW Paints is very strong in tier 3 and tier 4 towns. So the sum of the two will allow us to increase the JSW presence in metros in tier 1, tier 2, and increase the presence of Dulux and other products in our tier 3 and tier 4. There's also huge synergy on the distribution side. If you look at the distribution side, Dulux follows a direct-to-retail model in metros and tier 1, whereas they follow a distribution-led model in the smaller towns. JSW Paints is a direct-to-retail model across the country. So once again, once we get in and hopefully get all the approvals, CCI, and complete the open offer, that's when we'll actually get into the business. We'll understand the brand architecture that we want to go with. We will reinvest in both the brands. We will build up the Dulux brand and dial that up, because it's a household name that everybody knows, but we want to get it back on the tip of everyone's tongue like it has been, and also dial up the spends on the JSW side and truly go to the consumer with a combined offering, saying that if you're value conscious, you have JSW. If you want luxury and premium, you have Dulux. And across the value chain, whether it's wood finishes, waterproofing, construction chemicals, we'll bring the power of the R&D capability of AkzoNobel, and this will allow us to scale. And I'm sure the other retailers that you mentioned who are 4x and the number 1 is 4x of the number 2 and all of that, I'm sure a lot of them will be looking at us and being like, look at these guys. Now they have the complete offering, they have global R&D know-how, they have global capabilities, and they have the power of an Indian group behind it. So let us, why are we over leveraging on one of those brands? Let us join hands with Dulux and JSW and work with them. So we would welcome them, and we hope to scale very quickly.
No, so wait, let me go back to that. What do you mean by let us join hands?
Means let us also sell their product. Why are we selling only their product?
Okay, no, I just thought, is there more M&A in the offing or more
I'm
consolidation?
saying the retailers.
Okay, the retailers.
The retailers,
okay.
they might look at an alternative as well, and now we become a more attractive alternative because we give the complete offering. We give them Dulux, we give them JSW's offerings all together. So now they can really compete with anybody else.
So, I was reading your quotes also from the press conference earlier in the day, and one of them is that we will be the #1 brand. I don't know if you were misquoted, or aspire to be the #1 market share leader in this space. Is that aspiration there? How do you think it can happen? What is the timeline you're looking at?
No, I don't think I said that. I think the first step for us, which is very clear and it's on the horizon, is from the 4th largest player together, can we come into the top 3? And coming 3rd is something that I think we will definitely achieve very quickly.
You're on the verge. I think it's 11 and 10 between number 3 and number 4. So you're nearly there.
No, the pecking order is 30,000 crores is Asian Paints, 11,000 crores is Berger, 7,500 crores is Nerolac, and 6,000 crores would be the combined entity. So the first step would be obviously from 6, how quickly can we become number 3. But in terms of the brand, I truly believe that Dulux has the power of being the #1 brand in this country. And that's what we want to invest in. That's what we want to amp up the spends on and match the #1 market share player in the amount we spend on the brand.
So suffice to say, no change in the name of the brand, of course, because that's the key proposition. What about in the name of the listed company or the branding of the listed company? What happens to that entity? Is there a reverse merger? Any light that you can throw on that?
Yeah, once we complete all the process and come into majority ownership of that entity, we will change the name of that company to JSW something.
Okay.
And in terms of the reverse merger, like I said, first we want to get into that business. We want to understand the cultures. We want to start unlocking the synergies. And at an opportune time, the natural thing for us to do would be to reverse merge JSW Paints into this entity.
Okay, so it'll still be a listed entity
100%.
that will continue to be there. Just a word from you, Greg, on how you see the Indian paints market now. And you've had that ringside view. It becomes more of parts problem right now to make Dulux the first #3 and then move it up the chain. But how have you seen it and the kind of, I think, dip in appetite that we have seen in the space?
It's an interesting time in history in the sense that there is a deep-pocketed player that's decided to throw money at the issue. It disrupts the market a little bit because you've got a historical market leader which has been struggling over the last few quarters. And if you look at the competitive landscape, everybody reports their numbers because they're all listed. AkzoNobel India Limited is the one player that's continued to hold up really well in a market where some other players are under profit pressure and also under volume pressure. So what that tells you is that there's strength in the brand, that the premium positioning is also a natural defense against somebody who enters with mass market aspirations. But also this is, people like to think that situations are unique, but history repeats itself. There's a lot of countries where players from the cement or the gypsum board industry have tried to come in by building a brand from scratch. You had that in China 10 years ago. I could give you a few more examples if you give me more time after this conversation. And usually it doesn't end well because building a brand is really expensive and it's really time consuming. And India is not a market that is lacking for capacity. If you take our combined businesses, we can pretty much double the size of our business with the existing capacity. So building factories doesn't bring you anything. It brings additional capacity to a market that already has capacity. Building a brand is tough, and I think that Parth and the JSW Group made a very wise choice, which is that it's better to buy a brand that's already established, especially one with the credentials of Dulux, and build on that rather than to try to go bottom up from a blank page. But at the end of the day, these things, as they've happened in other geographies, they settle over time because most people over time want to make money in the businesses that they're in, and otherwise they choose a different approach. So let's let the Indian market settle down. I think there's going to be 2-3 years of turbulence. On the deco side, the coating businesses are doing really well, and then you'll see a market that will stabilize, that will mature, that'll probably consolidate a little bit more, and I think that bodes well for the prospects of our business, your business, pretty soon going forward.
Yeah. So on the consolidation aspect of it, on the bottom up, I'm not saying the top 3 players part, but more smaller players that exist, not all of them listed, some of them listed. Do you think it makes sense with the ambitions that you've now outlined to start shoring up? And like Greg said, this is an issue that one big player is throwing money at. Yeah. That's something you're going to have to do.
No, I think I don't think it makes sense for us to look at any of the smaller players unless there is a smaller player with proprietary technology that we don't already have access to, which I don't believe is the case because of the partnership between JSW and AkzoNobel. So I don't think any of the smaller players would be attractive for this combined entity to look at, and I think now the focus is really going to be how to leverage the synergies and how to scale up the business.
But the positioning is going to be premium because that's what Dulux's positioning is.
Yeah, so like I said, we need to fight in every segment. We're not going to only fight in the premium segment. And hence, once we get into the business, we have to arrive at the brand architecture and make sure that we can fight in the value segment, in the mass premium segment, in the premium segment, everything, waterproofing, wood finish, construction chemicals. We have to be fighting in all segments and gain share everywhere. So hence, we are not yet clear on what the brand architecture is going to be. But obviously, Dulux is going to play a huge role in that because it's the biggest recall brand, now in the JSW stable probably.
Yeah, I think that tune, right, of that ad, which we've all heard growing up. Yeah. Why don't you guys say it?
Dulux, Dulux, Dulux.
Oh, perfect.
I can't match that. That's wonderful.
Super. Best of luck, guys, and thank you so much for your time with us today on NDTV Profit.
Thank you.
And there you heard it from Parth Jindal and AkzoNobel CEO about the capacity and, of course, what's lying ahead with regards to this blockbuster combination of JSW and AkzoNobel. That's all the time we had on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
and is a pride of the country. यूजर फ्रेंडली है, एसबीआई के ऊपर सबसे ज़्यादा ट्रस्ट रहता है.
Wherever I am, even in the rural most areas, I still can find SBI.
Indian banking starts, and I would say even end with SBI.
This office has shaped the way State Bank of India thought about its role in the rural development, in supporting the MSMEs, in the industrial financing activity, both new age as well as conventional industries.
Imports become the exception rather than the norm, and increasingly we do almost last year, for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100%.
Hello and welcome. You're watching Know Your Company. I'm Harsh Saita, your host, and today we're going to be talking about Fino Payments Bank. Why Fino Payments Bank? One, there is plenty of talk around technology and banking, and Fino has been at somewhere at the periphery of it, or is it at the center of it? And that's what we'll try to understand better. But essentially, it's a bank where plenty is happening. They're converting from a payment bank to a small finance bank. They have applied for that license. How quickly does that license come will be the other big question. But it could well be a turning point in the way you look at the business as well. From the highs of the IPO price and the list price, the stock is trading now at a substantial discount, while profits over the last 3 years have compounded at a fairly healthy rate. And therefore, you want to start to understand whether this business has started looking interesting or not. So first question that I really want to know is that how much can the existing business grow by? You have your traditional business which they do at this point, and I'll explain that business to you. And thereafter, the kicker will likely be the small finance bank license, where they go into lending, and how that journey goes along will be completely different, and that will be a different lever both in terms of valuation and growth. The second piece is what's the outlook like on commission based income. What do they do in commission based income? One, they do remittances. These days, for remittances, say for example you have a house help who you pay 20,000 rupees to. They have to remit some amount or some part of that amount to their village. Earlier, they used to take the help of someone like a Fino to make that payment to their village, and their parents or family would collect it from an outlet of Fino. But not anymore. With UPI really well entrenched, you could well see that remittance number has come off, and which is what in some form or shape also impacts the business. Is there a substitute to that, or is lending the only thing? Then of course there's Aadhaar enabled payments. For example, all the government related subsidies and incentives are now done through Aadhaar related payments, all done over UPI. And then there's micro ATMs. Who uses ATMs anymore, or rather there's been a sharp reduction in the usage of ATMs, and therefore does that also impact the business? Competition in loan referrals, that's the other risk, right? So they've ventured into loan referrals, and then you have these large players, a Paytm, a Paisabazaar, who have come in and are disrupting, and they are all online. None of them are offline, and therefore is that business really seeing pressure? What changes with a small finance bank license? Now this is the big question, because you want to know whether the small finance bank license adds risk to the balance sheet in a substantial form, and if they are lending, what is that risk? Because if you are buying into the stock or you are already invested, you want to know what the risk will be of getting this license and how they intend to lend. Now the fifth question is, how quickly are you looking to get a small finance bank license? By one, I mean an SFB license. How quickly do they get it? How quickly does the strategy unwind as soon as they get it? Do they already have a strategy in place or not? And what happens to the promoter holding post the SFB license? Promoters currently hold around 75% through an entity, single entity. That structure may have to unwind at some point. Now, of course, that may take a year or two, but what's the thought process behind that? And the last question I want to ask them, where are you investing at this point? You're generating cash, you're a profitable business. Few businesses within the payments technology startup space are actually profitable, and this one is profitable. So where is it that they are investing that nearly 100 crore odd of profit that they are making? So all of that and more, but first let's understand what the business is all about. I'm going to start off with what Fino Payments Bank does as of today. The core business of Fino Payments Bank is digital and payments. That's what it essentially is based on. They've gone deep into rural, set up micro ATMs, and I'll explain this, and they have done digital through banking. So they do remittances, and then they provide financial services. So basic banking, remittances, financial services. Within basic banking, they allow you to maintain a current and savings account. They enable fund transfers, and they help you check your bank account through their app. which is all digital, all UPI. They've linked that entire stack to UPI. But what Fino cannot do is they cannot lend. Because they are a payments bank, they have a payments bank license, they absolutely cannot lend. So that is where the small finance bank license comes into play. They've applied for it. Earlier, there was no intention to do that. When I spoke to them at the point of listing, they said, we don't intend to lend at all. But that seems to have changed over the last 3 years. What has changed there is what I'd want to know. How they operate through an asset-light model, and it's phygital in nature. So one, they attract the customer into what is called a micro ATM. You'll have Kirana stores which will have a simple micro ATM machine which allows you to insert your card, enter your PIN and check your bank account balance. Once you check your bank account balance, you can withdraw from it. Say your balance is 10,000 rupees, you can withdraw 2,000 rupees. But there is no ATM machine there. It's actually the Kirana store owner who gets paid a fee, and 2,000 rupees is handed over by the Kirana store owner to the customer. So it's a very unique concept in that sense. And they have nearly 20 lakh touch points and merchants who they have tie-ups with. And therefore, they're one of the largest micro ATM players in the country at this point. I want to understand, can that continue to grow at the rate at which they've been growing? In terms of customers, well, they serve low-income individuals, migrants, small shop owners, and rural consumers. Basically, the target customers are customers with limited or no access to traditional banking and traditional bank branches and traditional banking channels. Once the customer is onboarded, then there is a simple app through which the customer can transact. So once that attraction is done, then the customer can transact through the application. So it's a phygital model. It's asset light because it does not require the company to open ATMs or open branches. That is not required given the way in which the model is structured. So where does it make money from? Let's understand it bottom up. Fino earns money mainly one through transaction based fee that's on your screen, then it's interest income. Mind you, these customers maintain balances. They may be very, very small balances, but they maintain balances nonetheless. And what happens is Fino has access to that money. That money gets parked with the RBI, and the RBI pays an interest out to Fino, which may be a very, very small or a thin interest, and therefore the net interest income may be very, very thin, but nonetheless that is income for Fino. So that's interest income they make, and then they make money on commissions. Any withdrawals, depending on the type of account you have with Fino, any withdrawals you make, any remittances you make, all of those get charged, and along with it, any loans you take. So the loan syndication that they do, any insurance products that get sold to you, all of those come through commission. So you have 85% of the revenue coming in from merchant commissions and fees on transactions. Then you have interest income from investing customers which invest in customer deposits in safe instruments, which Fino invests in safe instruments. And then there are commissions from selling insurance, referrals, value-added services and the like. And that's where all of the almost 85% of the top line essentially comes from. Let's talk about the exact services that they do. One, they do money transfers, and this is mainly domestic. Then they have Aadhaar-enabled withdrawals that they do. They do UPI and bill payments for their customers. Savings and current account maintenance for customers. Micro ATMs, cash withdrawals, deposits, does both withdrawals as well as deposits. Debit cards and prepaid cards are issued by them or are enabled to be issued. Insurance and gold loan referrals are made. And then there is CMS, which is cash management services. Now, what is cash management services? And this is a new opportunity for them. Basically, if you are a store, if you are a Kirana store, you have lots of cash with you. What they provide to you as a service is they will pick up the cash from your shop, deposit it into your account for you. That makes life easier for you. And there are a few players in this cash management services business. It's a difficult business to do, but given the way in which Fino payment has penetrated, it becomes easier for them to do this business. So cash management services is the other thing that they do. What does Fino spend on? One, interest payment on the deposits that they take from their customers, merchant payouts and agent commissions that they make, employee salaries, admin costs, the general, and then you have tech and platform expenses, which enables digital for their customers. Now, this is all with regard to Fino. So we hope we've given you a good coverage with regard to how Fino operates. Now let's talk about some numbers and let's break down all of the 8 metrics that we'll talk about today. We'll start off with the income statement, the balance sheet, the cash flow, the return ratios, shareholding, street cred, street coverage, and valuations. We'll cover all of these. Let's start off with the income statement. I'm going to start with the top line. 22% growth on the total income number over the last 3 years, which is very healthy compounding that we've seen. We'll look at EBITDA here because, mind you, this is not a bank. This is not your traditional bank where you will look at operating profit. You will look at EBITDA because what you want to judge from that number, or rather EBIT or earnings before taxes, what you want to judge from that number is compounding happening there. Because post expenses, you want to see whether the company is still making money. And what you are seeing therefore is profitable growth coming through. 26% 3-year CAGR. That profit which has fallen from FY24 to FY25 is largely related to taxes that they've paid. Mind you, it was a loss-making company earlier and therefore they had carried forward losses which could be offset against any profits which they made all the way through FY24. So they were paying 0 tax till FY24. Now they've started paying taxes and that's why you're seeing that recalibration of profitability. But that likely to a significant extent is done. Now what we'll see in FY26 is a normalization. Hopefully there'll be growth from here, from this 86 crore number, and we'll quiz management on how that happens. But a 26% growth CAGR, not bad on a 3-year basis. So we've given this a thumbs up. Now let's look at the balance sheet. You look at the equity is at roughly 83 odd crore. It has retained earnings of roughly 600 odd crore and it has some amount of borrowing. But typically the capital adequacy is what is relevant if it converts to a small finance bank, and it has an 80% capital adequacy. So no requirement of a fundraise whatsoever, at least for the moment, unless they start taking on too much debt, which at the moment does not seem to be the case. So that's how the balance sheet is stacking up. We'll give that one a thumbs up also. It's a lean balance sheet for a 2,000 crore, 2,300 crore market cap company. So that's how it's shaping up. Now let's talk about cash flow. Now cash flow, very simple metric, right? I'll compare the cash flow from operations to the profit after tax. 86 crore was the profit after tax for FY25, 76 crore odd of operating cash flow, not looking bad. And therefore we'll give this a thumbs up as well. I want to understand one thing from cash flow. Where is it that they are investing? Is there substantial pockets where they are investing for the next leg of growth? That's the other thing I want to understand, and we'll understand that from the managing director and CEO as he joins us. Let's quickly look at return ratios now, because the cash which they are investing needs to have a healthy return profile. We've shown you the last 3 years ROE number. We've given it a neutral because it's just about in early teens. What you would want is a ramp up of this. But mind you, there's one thing you want to understand. As businesses achieve scale and size, the ROEs start to creep up automatically. This one is a small business. It's a 2,300 crore market cap business. I want to understand whether it can achieve that scale and size and ROEs can see a lift or not as a result of that. So we'll see how that plays out. Now let's look at shareholding pattern. So we've given this a neutral, more to be seen on the ROE front. Shareholding pattern, 75% is owned by promoters. Let me pull out that promoter holding. It's the promoters that hold this one are called Fino Paytech Limited. And Fino Paytech Limited is again owned by a clutch of companies, including the likes of an ICICI Bank as well. And then you have a BPCL as well, which has a holding in it. So it's got an interesting set of promoters with it. but this will be subject to a reverse merger as well. There will be some bit of overhang as that reverse merger plays out, but that is only post the small finance bank license being received. So a lot of restructuring will likely happen within this promoter holding group. There's very little DI or FI interest at this point. It's a small company as well. And therefore, you'll want to look out for some of these things. We'll give the shareholding pattern a neutral as well. Let's look at street cred now. The one thing that stood out for me, and those numbers flashing on your screen, is the fact that if you are an IPO investor, you've not made money on this one. And that's a possible problem, because as promoters, as management, you would want to leave some money on the table for the retail shareholder. That doesn't seem to have been the case. Maybe have been the intent, but wasn't the case. That's not played out. And therefore, what you want to see is some of that will likely either have to play out very, very quickly, or you've seen some bit of pain within that shareholder pocket, which have bought since the IPO and continue to hold. So I want to understand what's in it for them, right? Can we see a substantial ramp up in the numbers, and that likely might impact stock price? That's something, of course, that we'll understand better from management. But for the moment, we'll give this a neutral, because stock price performance not really outstanding, but just about average when you're looking at it the last 3 months or so. 24% returns is what it's given. Now let's look at how the street views this. There are 3 analysts that cover it. We'll be cautious about this one. 3 analysts that cover it with a return potential of 13%. While the returns are okay, but what really stands out for me is that there are just 3 analysts that cover it. It's a 2,000 crore company where 3 analysts cover it. So not bad in that sense. We'll give this one a cautious neutral as well. Let's talk about valuations last off. Now, 2 ways to value this, right? One is price to book, but this is not a traditional bank, and therefore price to earnings is the better way to look at this. And when I was looking at the price to earnings at 11 rupees a share, which is FY25 EPS, it's trading at roughly 25 times, so trailing 12 months. But 1 year forward is trading at 22 times, and 2 years forward it's trading at roughly 18 times. That's how the valuations are stacking up. We'll give this one a neutral as well, because not necessarily something which is very cheap, but is there an upside surprise to earnings is what I'd want to understand. Let's quickly pull up all of the ratings now, because we've summed it all up. Now let's quickly pull that up. That's what you have. No issues with regard to the first 3 metrics, and the other 4 are also a neutral. No thumbs down. If at all there's a negative bias, it's with regard to street cred. That's something you'll want to look at, because that's not helping its case at this point. But 5.5 on 8, very, very fair from a KYC ratings perspective. Let's go across. We're joined by Mr. Rishi Gupta, who's the MD and CEO at Fino Payments Bank, joining us live. Good morning, Mr. Gupta. Always good speaking with you. I want to start off by understanding where does growth go from here? You're currently at around 19 lakh merchants. Can that number continue to grow? Can you continue to penetrate? And how's the competition looking at this point? Sir, I believe you're on mute.
Yeah, can you hear me now?
Yes, I can, sir.
So, good morning to you and to your viewers. So, good update on the KYC, and 5.5 from my point of view looks a little low, but I leave it to you and your analyst. Coming to your specific questions on the merchant addition, I think that is an area we have been adding about 1.5 to 2 lakh numbers per annum. So we'll continue to add that number of merchants as such. The only thing which has changed over the last 3 years, I would say, is that Fino was largely, the revenue and the profit was largely coming from the physical network of our merchants and the products which we used to sell through those merchants. In the last 2 years, and specifically in the last 1.5 years, we have seen there's a large push because of the UPI ecosystem which has come up. And that is where we see a digital transaction also growing to a large substantial part. Roughly 49% of our transaction value is coming from digital now. So Fino has become both a physical and a digital company now. So we have become truly a phygital company. So not only the merchant growth, but the digital growth makes it even more robust and more avenues for us also to make revenue and profits.
And sir, how is the loan syndication business going for you? The loan referral business. Again, are you seeing competition there? How are take rates looking at this point? How is growth going for you?
On the lending part, we have applied for a small finance bank license. So internally, we have working with a couple of NBFCs on the lending side, largely around gold loans, micro lab, kind of affordable housing are the 3-4 products which we are focusing on. We do about, between us and the BC business, about 150 to 200 crores we do every month on the gold loan and other products, so to say. While we are growing that number, but I would still believe that with partnerships, you are dependent on the partners, whether it is for the rate of interest or the product configuration or the geographies which are there. Once we get a small finance bank license, at that point of time, this learning will definitely help us to get into those businesses in a more controlled fashion where we control the product per se. So it's been a good growth, but I think the opportunity and the demand is far more as such. So we are going along with that, and let's see how it spans out in the next 9 to 12 months.
So give us the outlook on top line. I'll reserve a couple of questions on small finance bank. Let's keep that out of the picture for the moment. The existing business on 1850 crore of top line, where does it go? Say in the next year, say in the next 2 to 3 years.
So for that, you will have to probably break up this entire business into 3 lines. One is the entire deposit base, which is the CASA number. That CASA number, we grew at about 40% plus last year. We expect the same growth around 35-40. The base has gone up. So from a CASA point of view, I think we'll see a good growth coming on that side. Digital also grew at a much higher pace for us in the last year, nearly 4x of 24 number vis-a-vis 25. So in that sense, we also believe that the digital number will grow, but may not be growing in X, maybe growing in some percentage as such. Our transaction business, which is the micro ATM, APS, and remittance, has seen a degrowth in the last 2-3 years, and specifically in the last 1 year, because some of that is due to regulatory changes, some of them is due to customer behavior changing or moving away from cash to digital. And also a lot of those customers who used to do this are now my own CASA customers. So we see a degrowth on that because there are a lot of moving parts in the business right now. As you understand, the government is also pushing a lot on the digital frauds and cyber frauds, mule accounts. So we are also taking a very risk calibrated approach. So giving a guidance at this stage looks a little difficult because of the moving parts within the 3 lines of businesses which we are having. But one thing which we are very sure is, as Fino has always been very bottom line focused. So I see a good healthy growth on the bottom line per se. On the revenue side, even if we have to compromise somewhere on the revenue, but the bottom line is something which we'll continue to focus on. But our approach in this 25-26 is to be a little cautious and take a more risk calibrated approach on the growth side, not to grow exponentially at the cost of the risk and the ecosystem which is currently we are facing in the country.
Sure. Okay. So non-committal on the top line, on the bottom line focused. So yes. Would 100 crore plus kind of PAT run rate be something which is reasonable to expect?
So last year we had about 93 odd crores of PAT, where we had a 18% tax incidence. Because in the first quarter we didn't have tax. From the second quarter onwards we started to have tax. Our target is to cross maybe 100 crores of PAT this year with the full 25% tax incidence. So partly you are right in that way. So we will be focused on the PAT numbers on the bottom line. And so we are working on some renegotiations, some working on other businesses, some new lines of businesses, some new products as we go down the year.
And so what is the, where are you investing your surplus cash? You're doing 100 crore of PAT now, cash much more than that. So what's the kind of thought process behind where you're investing?
So 2-3 things are largely 95 to 98% of our investments are into technology. In technology, there are 2 lines of investments. One is the investments on building capacities and also security systems and everything else. With the kind of tech focus which is there within the company, and also the focus of the regulator is to build up a very very scalable as well as secured technology ecosystem. So we continue to invest in building up that scalable, speed as well as secured system as such. So that is where a large part of the BAU investments are going. On the other side, the large investment which we did in 24-25, which will get capitalized in 25-26, is the ecosystem around our core banking platform and some of the whole of the core projects which we have taken up in 24-25, which we'll see in 26. So these are projects in which we are moving out of core banking platform from FIS to Finacle. So that is going to get capitalized in this year. So that's where the large investment on cash side you mentioned in your KYC presentations also is going to happen. But that is only one of which happened in 24-25.
Sure.
In going forward, we don't expect that kind of large investment to happen on the technology side per se. We will continue to add more technology platforms, automation platforms. AI is something which we are working on.
Sure.
So that is moving away from, say, right now, the payment which we do to FIS is coming under OPEX as part of our operating cost above the EBITDA level. So once we capitalize this, a large part of that payment is going to come within the depreciation. So it will move from above EBITDA to below EBITDA to that extent. And but the benefit to the company with latest technologies, latest software systems will be much more than the current ecosystem which we are.
Got it. So is there an aspiration to grow PAT? Would late teens be a good number given that you're in any case a small company in relative terms?
So I think we spoke about PAT a few minutes back. So that is what I would leave at that. Our focus will be definitely to grow the PAT even with the higher incidence of tax in this year.
Sure. So completely out of time. Thank you so much for coming in, speaking with us, giving us all of that perspective. For viewers, some quick perspective in terms of the lending. I think what he gave us is that as the small finance bank license comes, they're already doing some amount of lending or enabling lending through their current existing customer base. So they'll probably use that data to kind of onward lend as well. So maybe that's something, that's another lever that one needs to look out for. But not particularly positive with regard to growth, which was something I was anticipating or hopeful for. Completely out of time on this edition of KYC. Thanks for tuning in.
And it's a pride of the country. यूजर फ्रेंडली है. SBI के ऊपर सबसे ज़्यादा ट्रस्ट रहता है.
Wherever I am, even in the rural most areas, I still can find SBI.
Indian banking starts, and I would say even end with SBI.
This office has shaped the way State Bank of India thought about its role in the rural development, in supporting the MSMEs, in the industrial financing activity, both new age as well as conventional industries.
Imports become the exception rather than the norm. And increasingly we do almost, last year for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Now, there is one investment that if you had made over the course of the last 10 years on a compounded basis would have done better than an investment in the Nifty 50, and that means that it would have done better than quite a few other investments. And some of you will already know what I'm talking about because you've invested in it, whether you like it or not. You've bought gold. And if you look at the compounded annual growth rate of gold over the last 10 years, then when it compares to the total return index of the Nifty 50, gold has returned about 13.9% and the Nifty 50 is at 13.15%. We'll talk about why gold has been such a spectacular asset class and what you should do at this stage, because over the last few months, despite geopolitical tension in various parts of the world, gold prices have not moved up very substantially. We'll also talk about your strategy when it comes to silver, because a lot of people have been talking about silver versus gold. Usually there is a ratio that describes the value of gold versus value of silver, and it is actually the gap between the two is widened quite considerably. Will that gap be closed, and does that provide an opportunity for you? We'll talk about that as well. Joining me today is CA Abhishek Mehta, who is the founder of Invests Capital. Thanks so much, Abhishek, for taking the time. Let's talk about the performance of gold. Of course, you've probably been studying it for some time. Why is it outperformed?
So in the last 10 years, if you see, there are three major reasons why gold has outperformed the Nifty 50. One of the first major reason is there is a heavy buying from the central banks. If you see, China has added almost about more than 500 tons gold in the last decade, and even Russia has added more than 900 tons in their reserves of gold. 1/5 of the gold reserves today are held by the central banks. China and Russia has been one of the key players in adding gold reserves in their kitty. The reason is that China today, if you see China's numbers, China today ranks second in terms of GDP. It is second in terms of military forces. It is second in terms of foreign reserves. It is second in terms of market capitalization. But still, in terms of gold reserves, it is almost at the rank of 6th right now. So my estimate is that even though the last decade has been very good for gold, another one decade, like in the next 10 years, Russia and China together will be adding a lot of gold in their gold reserves because they would like to de-dollarize the foreign exchanges and get their currency stronger as compared to dollar. So that is one of the key reasons why gold has performed. The second reason has been, obviously in the last 3 years, we have seen a pretty good bull run in the gold market. The geopolitical tensions, whenever geopolitical tensions arise, obviously gold is known as a heaven and everybody moves to gold, whether it is US-China trade war, whether it's Russia-Ukraine, whether it's India-Pakistan, all the wars have led to the increase in gold prices. Third reason is always gold is a very good hedge against inflation. So whenever, like we also do asset allocation, we tell clients ki invest some amount of bit of your money into gold because it is one of the best asset classes to hedge yourself against the gold.
Okay. So those are three reasons why gold has outperformed. Now, I do want to ask about the best way to buy it though, because Abhishek, and I know this conversation has happened so many times, even I have had this conversation several times, but it bears repeating. A lot of people think that investing in gold is going out and buying gold jewelry. Now, there are so many digital options available. Unfortunately, the sovereign gold bond is no longer available. So with that knowledge, what is the best way to invest in gold? Would it be through the gold ETF?
So before we jump into how to invest, I would also like to, talk about the risk before. Because I personally believe that once we go into an asset class, first let's talk about the risk. If you see the standard deviation of gold over the last 10 years, it is about 18.25%, whereas silver is 23.75%, which means silver has a higher volatility rate. So whenever you are choosing between the two asset classes, whether it's gold and silver, be aware that you will face more volatility in terms of silver. So silver should always be bought in a staggered manner. Now, how can one invest into gold and silver? There are two major methods. One is ETF and second is fund of fund. ETFs is a very good method. You can probably purchase 100, 200 rupees also, 500 bucks also. Lot of time investors confuse that their actual physical gold returns and the online gold returns will be same, but that will not be the case because of three major reasons. One, when you go and purchase from a retail shop, you have to pay GST. Second, you have to pay making charges. Third, your retail gold prices are always higher as compared to wholesale rate prices. So I would like to urge all investors, if you are going and purchasing gold as an investment asset class, always go for ETFs or fund of fund, and especially for silver, go in a very staggered manner because silver has a very high volatility rate as compared to gold.
I want you to describe this. Now, a lot of students of mathematics or even economics will understand what you say when you say standard deviation. But
Yes.
from the perspective of price movement over the course of 10 years, what this would mean is that there could be a deviation at any given point of time up or down by as much as 18% from the long period average. Is this correct?
Right. So I always, in a simple manner, it is the turbulence which you face. So when you catch a flight, the amount of turbulence you will face from going to your destination A to B. So gold will give you a turbulence of about 18.25%. Consider it as a pendulum. So it can go 18.25% down, it can go 18.25% up. And silver will give you a turbulence of 23.75% when you are going from one destination to another.
So we've established what that is, and in the meanwhile, the Nifty 50 total return index had a standard deviation of 12.6%, which is at any given point of time, it will still give you a positive return even in a lean period, whereas a gold investment at some point of time you could turn negative over the course of that 10-year period. Basically, this is what it means. But you've also told me about the efficiency ratio. What do you mean by that?
Efficiency ratio basically means for every 1 unit of risk you are taking, what is the return you are generating. So it is basically return divided by the standard deviation. It just gives you that whether my risk was perfectly correlated with the return or not. So Nifty 50, if you will see, the efficiency ratio turns up to 1.04%. For Nifty 500 index, it turns up to 0.92. For gold, it is 0.76, and for silver, it is 0.48. So silver has the least efficiency ratio because of the higher volatility rate. And also silver in the recent year has not underperformed, but to its peer, it has not performed that good as compared to gold. But I personally feel that in coming next 10 years, silver might be a very good asset class because it has gone away from the precious metal. Nowadays, silver is being used in a lot of things like EVs, solar, your medical devices. So I personally feel that in the next decade, silver would be an asset class which will outperform gold in a period of next 10 years.
Okay, so and that's an important point that you make, because we're looking at all of this in the rear view mirror, Abhishek, and we've seen a tremendous rally for gold. As things stand right now, like I said, that gold-silver ratio is at the widest that it has been in a long time, and so from that perspective, what you're saying makes sense. We could see a rally in silver prices, and so if we have a conversation 1 year from now, maybe the figures that we've just spoken about will be different. But having said that, what you just referred to, I was reading that that 2/3 of demand for silver actually comes from industrial sources. So exactly what you're saying. And so when demand goes through for industrial sources of silver and supply constraints are resolved to a certain extent, you can actually see a rise in silver prices as well. But having said that, how should an investor invest in silver? To what extent should they invest in silver and gold?
I think you can invest almost about 10 to 15% of your wealth into commodities like gold and silver. Like I said, one of the best ways to do it, not through the physical channel, but through ETF and fund of fund. What's the difference between ETF and fund of fund is more or less on the taxation part. ETFs are more better as compared to fund of fund because ETFs will give you a 12.5% taxation after a year, and fund of fund will give you a 12.5% taxation after 24 months. So the best way to invest into gold or silver, I think probably you can buy silver Bs and gold Bs through the ETF channel, and it will give you a taxation of only 12.5% after a year. Also, physical holding, has a lot of hassles, Alex, because every time you want to go and sell, you have to go out to your house, you have to find the rates, then sell it out, and the liquidity becomes an issue. Whereas the liquidity is much better in terms of ETFs. You can just go on your app or call your broker and sell those ETFs very easily. I would also like to point out one thing is gold and silver has a negative correlation with Nifty 50. What does negative correlation means? Whenever Nifty is negative, gold outperforms Nifty. So if you see the past data, let's look at some data. In 2003, Nifty was down by 11.7%, but gold was up by 8.4%. In 2009, Nifty was down by 35% and gold was up by 26.80%. What does this mean is that you should not put all your eggs in one basket. The negative correlation in an asset class is very good because when one asset doesn't perform, the second asset class will perform. So that will reduce your volatility in the portfolio level and give you a better returns.
Okay, quick question on this and then we move into asset allocation. When you're buying an ETF, what is the efficiency of the ETF? And by that I mean in terms of pricing. For example, if I go to Zaveri Bazaar and if I were to look at the value of gold, they will give me the market rate. But on an ETF, there is sometimes a dislocation and it's not exactly that same price. How likely am I to get the market value as close to market value when I'm buying gold on an ETF?
So in fact, the efficiency is much better when you are buying, because when you go to a wholesaler or retailer, he obviously keeps his spread. Whenever he is buying, he is selling probably $1,000, lower, and whenever he is selling, he is charging you $1,000 more. So more or less, you would get a 99.99% efficiency when you are buying an ETF as compared to physically going and getting the gold.
Okay, got it. Let's talk about asset allocation, because you said 10 to 15% in gold and silver. But what happens with the rest? Because a lot of people have this tendency, Abhishek, to run after things that are doing well. So if, for example, gold is suddenly running up, then they'll say, why not put more money in gold? And the entire asset allocation goes for a toss. Is there I know there are lots of thumb rules to follow, but incidentally, when we were talking about, you said that asset allocation goes back to the 4th century BC.
Right. So I was just reading about asset allocation recently, and I came across thousands of years back, Jewish came with a literature called as Talmud. So what does that means is, they said that divide your money into 3 asset classes. One is physical, where you buy gold, real estate. Second is you buy businesses. So probably you invest into equity, you invest into mutual funds. Third is you buy debt products or products which are liquidable. So they wrote thousands of years back and they back tested it at that time. So what they came out with this result was that if you follow this method of 1/3 into physical, 1/3 into commodity, 1/3 into your liquidable assets, then 9 out of 10 years, you will be in the top 25% returns. The only important thing is you have to rebalance your portfolio every single year in a disciplined manner. That means you have to sell whatever has gone up, you have to sell your winners and buy your losers. If you keep doing that, in 9 out of 10 cases, you will be in the top 25% asset allocation. Now, this Talmud portfolio was also taken ahead by Markowitz, who won the Nobel Prize in 1990. The same portfolio was also referred by Roger Gibson in his 1998 book called as Asset Allocation. Asset allocation has 5 key takeaways. I would like to discuss that because people always they listen about asset allocation and they keep it on the back seat while investing, because people get more interested in investing in asset classes which have performed better in the near future. There are 5 key takeaways for the asset allocation thing. The first thing which came after the Markowitz theory is your return and risk both are calculatable. What does that mean? Return is very easy to calculate. You put 100 rupees, you get 200 rupees, you say, I got 100 rupees return. But you need to calculate your risk as well. How do you calculate your risk? Like we said earlier, through your standard deviation. The second key takeaway of your asset allocation is that more risk always doesn't mean higher return. After a certain point of efficient frontier, even if you keep taking higher risk, your returns will not increase in the similar linear fashion. The third key takeaway is adding asset class into your portfolio will reduce the risk but not reduce your return. So always have about 3 to 4 asset classes in your portfolio. Fourth thing is rebalancing is very important. Rebalancing, it's like in your employment, every month you get salary, and at the end of the year you get a bonus. So if you do rebalancing will give you a rebalancing bonus after a longer period of time. Also, rebalancing helps you to stay disciplined. In bookish knowledge, we always hear that you should buy, low and sell high, but we are not able to do that because we don't have a perfect asset allocation in place. So asset allocation really helps you to stay disciplined when you are investing in your journey.
Okay, so some key takeaways of asset allocation, and those points are well made, particularly the one when it comes to averaging both on the upside and on the downside. It's not the easiest thing to time the market, and not many people can. So follow a simple asset allocation strategy, as Abhishek is suggesting. Let's talk about a scheme or category of mutual fund schemes that is doing exactly this without you having to churn too much. And this is multi-asset. We speak about it incidentally, Abhishek, whenever we speak about gold, but I don't think that should be the case. And I know that mutual funds have different interpretations to how they do this multi-asset strategy. So let me ask you this. If we were to look at the key functionality of these schemes, to say return maximization would be one, the second would be absolute balancing of asset classes and shifting between asset classes, and the third being capital protection. How would you describe these three principles and talk about schemes in the same category?
Right. So one very good category which mutual fund has evolved it into is called a multi-asset allocation fund. How did this evolve? Earlier, there was 100% equity where 100% of the money was getting invested into equity. Second, what came is a balanced fund. What was balanced fund doing? 75% equity, 25% debt. The fund got evolved more, the category got evolved. They came up with a balanced advantage strategy. What it used to do is, it used to play between debt and equity, and say whenever the equity is on a higher side, they would go up to 30%, 40% on the equity level. Now, after that, this category has evolved further, and they have come up with a category called as multi-asset allocation. What does multi-asset allocation means? You have to have minimum 3 asset classes in your portfolio with a minimum 10% asset allocation to all these 3 asset classes. We will discuss 3 mutual funds of this category. One is DSP mutual fund, second is White Oak mutual fund, and third is ICICI. ICICI is one of the leaders in this segment. They are managing 52,000 crores in today's multi-asset allocation fund. The fund is managed personally by Naren and 2 other fund managers. What does this fund try to do is, they try to have a 65%, more or less 65% equity exposure. Second is, they try to have some exposure on the debt side. Third is, they have an exposure on commodity side. So if you see the asset allocation today, they have an equity portion of 52%, debt portion of 35%, commodity is about 12%. So they have divided into the 3 asset classes. The entire agenda of the fund is more or less to have lower risk as compared to Nifty and deliver better returns as compared to Nifty 50 by doing the asset allocations. Now, what is the difference in this fund and the other 2 funds is that of the taxation. they try to mirror an equity taxation, which means they at any point of time have to keep 65% of their funds into equity, and then probably they try to hedge it with the options. But the first agenda, because they cannot go below 65% to get an equity taxation, they have to always try and chase the equity side more as compared to chasing the other asset classes. DSP and White Oak comparatively are really going by the T of being a multi-asset allocation fund. What they have done is, first, in terms of taxation, they don't follow an equity taxation strategy. They follow a taxation strategy which states if you have more than 35% allocation in equity, you can put your money for 2 years and have a 12.5% taxation. So first, they are stress-free in terms of keeping 65% allocation in equity. Now, how does White Oak does is, White Oak has 31% in equity, 56% currently they are having in debt. They are having about 4% in commodity, and they have put in real estate and REITs and invest as 7.5%. So they are particularly trying not to beat the market, but to be a pure asset allocation play where having 3 asset classes. One is equity, second is debt, and third is real estate in their portfolio. At the same time, DSP is doing something different. What DSP is trying to do is, because they are master in picking foreign equity, they have an Indian equity exposure of about 37%, foreign equity exposure of about 21%, debt is 25%, and gold and silver is about 15% in their portfolio. They have one of the wonderful names in the foreign equity side. They have GE, they have Amazon, they have Nike. They're one of the funds which is DSP Value Fund. Still holds Berkshire Hathaway as a share. So because they are, very good in picking foreign stocks, they have a foreign flavor in it. White Oak is good in, picking, Prashant Khemka is good in picking the real estate side. So they have a flavor of real estate in them. ICICI multi-asset allocation at the same time is having more towards the equity side because Naren is a pure equity player in its investment strategy.
Yeah.
If you look at the standard deviation of all 3 products is very different. ICICI multi-asset allocation fund has a standard deviation of about 12%, which means almost like an equity fund. Nifty has a standard deviation of about 13-14%, and they are having a standard deviation of 12%. White Oak has a standard deviation of only 4%. Its 1-year return of White Oak is 15%, yet it has a standard deviation of only 4%. So White Oak is really, living by the T.
Okay, so you've actually elucidated that point. You want to very quickly tell me what the standard deviation for DSP's multi-asset fund is?
8.54%.
Okay, so that kind of bears it out, right? Because the objective of each of these schemes is slightly different. So when you're investing in this category as well, which a lot of people tend to do because they say these will give me gold allocation, it's not always necessarily true. It could actually be true, but it's not always necessarily true. And I hope that we've given you some perspective, viewer, on how to look at these schemes and this category. Abhishek, thanks so much for joining me today. Absolute pleasure having you on the program.
Thank you so much.
All right, now, when it comes to your expenses, of course, it's easy to say that you should put a tab on it and you should see where you're spending. But there's one thing that you spend on that is difficult to put a tab on. This is a silent killer, if you can call it that. A lot of us pay for subscriptions. And the thing is that those bills can add up. How much are you paying? And what is the total cost that you might be footing? Well, my colleague Yukta has this report.
It's the beginning of the month, which means rent's gone, you've paid your electricity bill, and your digital subscriptions are silently auto-renewing in the background. Netflix, Spotify, Zomato Gold, Cult, Canva, Google Drive, that newsletter that you never read but swore would change your life. And if you're 20-something working away from home, these feel like needs, not wants. They feed you, entertain you, help you work out, and sometimes just offer the comfort of being there. And hey, there's no shame in paying for convenience. Whatever you need, there's an app for that. There's always an app for that. But sometimes along the way, it's easy to lose track. According to a survey from March 2025, urban Indians under 30 are spending an average of 2,800 to 3,000 a month on subscriptions, and 42% admit they've continued paying for at least one that they no longer use. Now here's what that spend typically looks like per month. OTT subscriptions could lead to around 800 rupees per month. Music streaming platforms like Spotify, YouTube Premium could be another 300. Food delivery and dine out perks, which have like Swiggy and Zomato, could be around 400. Fitness and meditation apps could be around another 800. Cloud storage and productivity tools like Google One, Notion Pro, etc. could be another 300. Courses and niche apps could be another 400. That for an entire year adds up to around 36,000 rupees. Now, none of this is useless. It's all stuff that makes life easier, right? But the problem is everything is a subscription now. And after a point, it gets a little much. Not just for your bank account, but for your brain too. Now, that's what people are calling subscription fatigue. Just feeling overwhelmed by all the small, ongoing payments and the mental load of tracking them. So here's what you can do to declutter. Step 1 is the audit. Grab your phone, check your UPI app, emails and app store. List everything you're paying for, monthly, yearly, and even those free trials that you forgot about. Step 2 is having an honest chat with yourself. Did I use this in the past 30 days? Does it make my life better? Would I even notice if it stopped working? Is there a friend that I can borrow this from? And am I already getting some of these for free with my phone recharge? And step 3 is pause, cancel and remind. Cancel what you don't use, pause the ones that you might return to, and for what you're already keeping, set a reminder a few days before the renewal.
All right, that brings us to the end of this edition of Your Money Matters. Thanks so much for watching, and do stay tuned. This is NDTV Profit.
And it's a pride of the country. यूजर फ्रेंडली है. SBI के ऊपर सबसे ज़्यादा ट्रस्ट रहता है.
Wherever I am, even in the rural most areas, I still can find SBI.
Indian banking starts, and I would say even end with SBI.
This office has shaped the way State Bank of India thought about its role in the rural development, in supporting the MSMEs, in the industrial financing activity, both new age as well as conventional industries.
Imports become the exception rather than the norm. And increasingly we do almost, last year for example, of the contracts that we signed of record 2,09,000 crores, 81% was awarded to the domestic industry. Our intent is to manufacture in India, preferably with design also in India.
I am so elated to be on the same screen as the Defense Secretary, and I get a chance to talk about what he said.
In certain areas, like for example, artillery guns and armored vehicles, or in some categories of missiles like the BrahMos and the Akash, we've come of age.
What Defense Secretary Sir said is 100% true, and today private industry can really increase their involvement in R&D.
I am very proud to say that we make, in our categories that we have been supplying to our defense forces, some of the best platforms in the world.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Do I buy Ola?
Should I hold ICICI CDSL for the long term?
Buy, sell or hold.
The answers you need, straight from the experts.
Callers from India and across the world. Connect live, ask, decide and
right, so chaotic traffic, jackets that get wet in the rain and pothole-filled roads. There's nothing more iconic than Mumbai monsoon, except maybe one thing, and that's the building that I was just looking at. On top of the building, you will see the Roman numerals for the year 1924. That's the year when this building was built. And what is in this building? Was State Bank of India's main branch for the city of Mumbai, right next to Hanuman Circle. And inside, we've got something interesting lined up for you. At the 70th anniversary of State Bank of India, what is it that you're seeing as something that is it a starting point? Is it a big milestone that you're proud of? How are you seeing this?
So thanks for having me here. I think this building is not only the Mumbai main branch now. Historically, the significance of this building for us is this is where 1955 State Bank of India corporate office was present.
Right.
Even prior to that, Imperial Bank of India was there. So from that angle, this building symbolizes not only age and architecture, it is also testimony to the trust, consistency in our service orientation, and being the very significant part of India's economic development. I think that is what it symbolizes. Coming to your question, of course, 70 years is the foundation of State Bank of India in the new avatar from 1955 onwards. But of course, this bank has a history of almost more than 200 years.
Yeah, 219. Yeah,
219. Yes, and this historical, background and the purpose for which State Bank of India was formed in 1955 has driven the way the bank has been contributing to the society at large and also for the economic activity of the country. I think from there you need to see the 70 years journey from that spectrum, that what is that SBI has played in the systemic role, what it has played in the economic development.
Okay, why don't we take a walk around the branch and try and figure out the history as well as, of course, the present and the future. Sure. So I want to ask you, this 100-year-old building, how are you feeling when you soak in all of these historical sort of, nobody here was alive when this building was born. How are you soaking it all?
I think this building, both as a corporate office of Imperial Bank of India and subsequently State Bank of India, and currently in the form of a very large branch of SBI, is a part of shaping the aspirations of people.
Right.
I think it's not only the number of retail customers who walk in here.
Yeah.
And over the years, the corporate banking aspirations and entrepreneurial aspirations of the people have been fulfilled over the years. And also, this office has shaped the way State Bank of India thought about its role in the rural development, in supporting the MSMEs, in the industrial financing activity, both new age as well as conventional industries.
Yeah.
From that angle, I think it has played a very, very large and important role.
So, 70 years in this avatar of State Bank of India after the SBI Act was born, right? To your mind, when you're looking at this history, what is it that stands out as, this is why State Bank of India was born, and this is why State Bank of India as a lender exists? How are you seeing those things?
I think first and foremost, you can't think about SBI without thinking about the great financial inclusion.
Yeah.
The role what SBI has played in that. First, to start with, this is the very purpose of this organization to extend rural credit. I think it has done a phenomenal job in terms of ensuring that the initial phase of its development, in terms of agricultural financing, microfinancing, small-scale industries financing, cottage industries, and take the banking to extremely unbanked areas. We were the first bank to take branches to many villages, many rural areas which have not even heard of banking in those days. So that's I think the very, very important role which you have to acknowledge whenever you talk about SBI, that people have been brought into the banking system. The second important area is that, that alone would not have helped. That how do you design your credit policies, procedures, and products so that, the people who are entering the formal credit system will be able to avail those benefits. And I'll just give you an example.
Why don't we come here and sit down and talk?
During 70s, when the government of India wanted that there should be a large-scale participation of SBI in MSMEs, we have not only taken up just merely extending the credit, we launched an entrepreneurial development program. We trained the people to, how do we set up a small company and take the economic activity. And another important project I would like to mention, what is called Project Uptake.
Okay.
How you ensure that the MSMEs on a cluster basis invest in technology. And there are other important milestones in SBI's journey, in my view, is that, see, the economic crisis from time to time.
Yes.
When the foreign exchange crisis was there.
Of course.
SBI has played a very important role in terms of India development bonds, Research in India bonds. And the other one which we must acknowledge is the digital adoption. How do you take this? If you say the later part of the 70 years journey, in the last one decade, SBI has played a very, very large role, either setting up new institutions or setting up our own technology platforms across the banking services. Is also need to be acknowledged that today we democratized the digitalization in the country. The last piece I would like to mention is in terms of our extending the financial services beyond banking. Today we have more than around 18 subsidiaries, non-banking subsidiaries, which provide different financial services. So the evolution of SBI from a mere banking entity to a financial conglomerate is an amazing journey in my view.
You joined the bank in 1988 as a probationary officer at that point in time. Now, of these 70 years, you've stayed with the bank for more than half. I wanted to get a few hits of your career, because obviously during your time at the bank is when the 1991 crisis happened, the 2008 crisis happened, later when the banking sector NPA crisis happened in India, after that multiple geopolitical crises that you witnessed, especially after becoming chairman. I wanted to get your sense of what your trajectory has been like.
So there's never a dull moment in SBI.
Of course.
See, I think whichever assignment you are there, you always have some excitement. But I don't like to call them hits, but a few very challenging environments, assignments which have helped me to understand and excel in those areas and also contribute in a significant manner was one. Definitely I would like to mention about the Deputy Managing Director stressed asset resolution.
Yes.
That was the most difficult phase where post asset quality review we had undertaken large scale identification, resolution. I think this process, it is not only that we have provided the leadership to the industry. This turbulent environment, we also, in my view, provided a calming effect. We have given assurance to the industry that how do we handle this large account resolution. So that is, in my view, I believe that is one of the major moments for me in the career. But the other one is in terms of Managing Director, retail operations. When I took over as MD Retail, we just entered the COVID. And during COVID, it was a great humbling experience to see how our staff members react and respond to this crisis.
Yeah, of course.
And when banking was declared as essential service, we, from a management perspective, we said that safety of our employees, safety of our customers, and if we can do some business, let us do business. But I'm very proud of my teams that, we have done phenomenal job in terms of providing the services. It also helped me to understand the resilience and strength of this organization in a much larger scale.
Yeah.
We have almost, you are familiar, more than 22,000 branches, more than 65,000 ATMs. The network had to operate. And we also had rural presence by way of business correspondents, so more than 70,000 of them. So every one of those entities have worked to the satisfaction of the customers. And I believe that, through that assignment, I could realize the power and potential of this wonderful organization.
Okay, I've heard a lot about this conference room in this building on the second floor, which was home to the Mumbai local board as well, when it was the Imperial Bank at that point in time. It would be great to have a chat with you there.
Sure.
Yeah, sure. Okay. We are now entering this conference room, which used to house some of the oldest board meetings in the history of State Bank of India in Bombay. What I wanted to understand from you is, now we are in this year of 2025. There is no real competition for State Bank of India in the current setup in India, in the Indian banking sector. But having said that, there is a expectation that it will only keep growing bigger and bigger. How do you, as a chairman of the bank, how are you balancing this, staying first but also focusing on being like a growing bank?
The competition is always there. I think the advantage for SBI, or the nature of SBI, is that always face the competition head on. So when you are number one, there is a greater responsibility, greater expectations. And also, see, we need to constantly redefine ourselves, to redefine the leadership itself. There's a lot of disruption. So when we look at leadership, we don't look at only at the size. Obviously, we have had the advantage of size, and we are maintaining that. It requires a lot of effort. It's not an easy task to maintain the leadership. But what we